When we've had big movements in trade deals, that it does create a lot of volatility, it does create a lot of noise.
Quite quickly, we're looking to come to agreements.
We're expecting an average effective tariff rate of around 14 to 15% by year end.
I don't think these tariff deals are going to be done that quickly. I do think the tariff uncertainty will continue.
We're all looking at sort of the black box right now, waiting as this information comes out.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, closing out Q2. The S&P 500 sitting at all-time highs, looking to cap off a 10% advance, even as the big beautiful bill hits some increased resistance in the Senate and trade partners struggle to strike a deal before the July 9 deadline.
I'm going to send letters. That's the end of the trade deal. We will say, congratulations, we're allowing you to shop in the United States of America. You're going to pay a 25% tariff or 35% or 50% or 10%.
A busy July is just around the corner.
Yeah, and the question really is, are we overly pessimistic or are we too optimistic at a time when you are coming off record highs for U.S. equities, good for stocks, good for bonds? They just had the best month going back to February. So at a certain point, are we baking in too much good news heading into this July 4th or July 9th deadline? Or, as I see Steve Chiavarone sitting next to me shaking his head about my pessimism, are we overly pessimistic because things have continued to grind higher and we still have a lot of stocks that are lagging behind?
We said this on Friday going into the weekend. It's worth repeating again. A 10% rally on the S&P 500 in the same quarter we had April 2nd. Think back to April 2nd. That is absolutely phenomenal. And even with these two deadlines, Lisa talked through them, July 4th, July 9th, both are set to slide at this point, both July 4th and July 9th.
Well, they are self-imposed, so maybe that's a reason why potentially they could slide in and of itself. I'm accepting that. But really, when it comes to the one big, beautiful bill, this is going to be a fight because not only does Majority Leader John Thune have to get a handful of senators across the finish line, which comes back to the basics we have been talking about from the very beginning. You have these different factions, those that want to see less spending, the fiscal hawks, those that want to see more health care benefits, and those that are really concerned about what's going on with the renewables. Once you give a concession to one group, you create a whole host of problems in another group. And even if Senator Thune is able to do this within the next 12 to 16 hours, then the House has to decide, are they going to capitulate and accept what the Senate gave them, or are they going to have their own fight?
This is business for Friday. Before we get to Friday, we need to deal with payrolls Thursday. Yes, payrolls Thursday. The estimate in our survey at the moment, 113 is the median estimate. That is down from a previous read of 139.
So this is the question that I have. There's a lot of payrolls risk baked into the market, this according to a whole host of different analysts over the weekend. And I'm just wondering, what is that risk at a time when people are expecting a low print to not necessarily represent weakness, but just the low churn of less immigration, less hiring, and less firing? How do we understand this Rorschach test of numbers?
Is it fair to say the debate will continue beyond Thursday into the weekend?
That's a neat way of putting it.
And stocks will maybe sit there at all-time highs and just ignore it all.
Well, that's the question. What's the sort of, come to Jesus moment in markets where suddenly you start to say, hold on a second, we can identify a trend and it's to the weaker point. And can you get the Fed cutting rates without that type of clarity? Because if you can, then you're in the Mike Wilson camp. All systems go, things can keep grinding higher. If you're not, there's a question about whether this Fed's going to be too late. We'll see cracks.
Equity markets grinding higher this morning, up another 0.4% on the S&P 500. Coming up this hour, Steve Chiavarone of Federated Hermes with stocks looking to add to record highs. The former senior White House trade advisor Kellyanne Shaw on the latest trade negotiations. And Aditya Bhave of Bank of America looking ahead to Thursday's payrolls report. We begin this out with stocks looking to close out a big Q2. Steve Chiavarone of Federated writing the following. We expect the grind higher in equities to continue as investors that overreacted to April continue to get pulled into the market. Steve joins us now for more. Steve, good morning, sir.
Good morning.
It's good to see you. Lisa mentioned Mike Wilson over at Morgan Stanley. His line this morning, the rally has been more fundamentally driven than many appreciate. Would you agree with that?
Yeah, I think that's the point that we were making in the quote you just had up. Right, there's a tendency when you're caught short and the market rallies hard on you to want to discount that rally. And then all of a sudden, and look, at the beginning of every rally, it's short covering or it's a bounce or it's, hey, tariffs got delayed, not canceled. And then other things start to happen, right? The Fed gets closer to cutting, which you can see that pressure is mounting. I think even Powell kind of hinted that September is likely to happen. You start seeing things like the big, beautiful bills start to move through the pipeline. Every reconciliation bill fails at least twice before it passes, so nothing that's happening this week really kind of has me thrown off there. Trade deals of some kind are likely to come. And underneath, earnings estimates have stabilized after falling right in the immediate aftermath of April. So what started out as just a relief rally is starting to become something real, and that's what sucks those investors in slowly and reluctantly.
Is that despite the data or because of the data?
The data's in an interesting place right now because one of the missing ingredients here is the Fed moving. And you're in a scenario where if data was too hot, then the Fed has all the excuse that they need to remain on the sidelines, whereas the data is softening enough. It's softening in a way that suggests the economy is slowing, but not softening in a way that suggests that there's some major problem. It's the same thing that Lisa mentioned with the payroll report, right? It's slower, it's showing less grind, but it's not showing massive layoffs. And I think that kind of slower data that pulls the Fed in, but isn't indicative of a major economic problem, is being seen by this market as a positive.
This is the key point, I think, is that Mike Wilson pointing to the idea of good rate cuts. Not necessarily any rate cut's going to be a bad thing because it's only going to come on really weak economic data, and that's kind of what you're suggesting as well. Why are we morphing into that again when that was actually anathema to what everybody believed just a month or two ago?
Well, not everybody. That's been what we've been screaming. I mean, look, I've been on this show at least once or twice a month for the last several months, and we've been wanting the Fed to move in the direction of at least preparing the market for cuts. And the reason why is not because we see a big problem, but because if the Fed can move earlier and gradually, then you have an economy that's slowing, and it is the good kind of cut. It's preventing a problem from coming. If you wait too long and you let those pressures in the economy build, then you find yourself behind the curve and you're in a scenario where you've got to cut much quicker, and it's because you have a problem. So I think you're on that cusp here. And if they move in the next two meetings, I think that's probably fine.
So we've been talking extensively about how the S&P 500 is not the economy. Mm-hmm. And increasingly, we've seen this divergence, and it's increasingly being led by the big tech names, and it really hasn't been led by everything else. You're starting to see small signs of broadening out, but how crucial is that broadening out to this idea that this is a durable rally that can get to 7,500 within the next 18 months?
I don't know that it's been that narrow. I mean, it has been narrow, but remember, during the April sell-off, Mag 7 got to a 2-3 year cheap in terms of valuation. It was the one thing we bought, and we've been in the camp of kind of broadening out now for a couple of years, but during that sell-off, it really was the large cap tech that took a big brunt. What you've seen since, though, is look at small caps. Small caps have participated since the April 9th bottom. It's some of the value names that have underperformed, but that's because their last earnings season was a little disappointing. So I think, yes, it has been growth-led. I don't think this is just a story of growth, though. I think this is a little bit broader. I do expect you'll see it broaden out. I don't know that you have to right now. I think this is a pretty healthy rotational rally.
When you look at the tax and spending bill going through Congress, and you say it's going to be moderately stimulative to the domestic economy, what parts of the domestic economy?
Well, I think you're doing a couple of things. I think you have to take it into account with tariffs and the tariff revenue, assuming something like a 10% across the board. When you do, all of a sudden, what looks like a $2 or $3 trillion increase to the debt just from the one big beautiful bill becomes something, when you add tariff revenue, that's basically debt neutral. If you add in a little bit of a higher growth rate, you can actually get to deficit reducing over the next 10 years. So it's not a big, huge stimulus bill where you're blowing out the deficit. But what you do see is using some of that tariff revenue, of which probably half is borne by the U.S. taxpayer, half by a foreign taxpayer, you're then delivering $4.5 trillion of tax cut extensions, plus a little bit extra.
But does the American consumer feel it? If they're getting a tax cut from Washington, but they're paying more for their everyday goods because of an increase in tariff from goods coming into the United States, is it basically just equal? Do they cancel each other out?
If you were just extending the 2017 cuts, I would say yes, then it cancels out. I think what you have here, though, is lower and middle income Americans feel the brunt of those price hikes the most. Rich people don't get paid in tips. rich people don't get paid in overtime. I mean, I've tried to reclassify my bonus as a
say,
tip,
speak for
but it
yourself.
doesn't work. But the point I'm making is that when you actually think about those particular new provisions, no tax on tips, no tax on Social Security, those are really designed to help out lower middle-income Americans that would feel those higher prices. And then I think the other provision you can't sleep on is the immediate expensing of CapEx. Because in the past, that's always been equipment. But this is plant and equipment, which I think will allow companies who might be reticent and want to wait out the administration in terms of investing in the United States to have such a good deal on plant and equipment that they may do it now.
Stephen Murray promised to sort out that bonus stuff, didn't he? Last time he joined us.
He said he would talk with the management. Let's see how that goes.
Looking ahead to payrolls on Thursday, Steve, just to squeeze this in, the estimate in our survey's 113. Yeah. There's a whole bunch of reasons why we might get a softer than expected print down near 100K. Does the market have the capacity to absorb a downside surprise on Thursday morning?
I think it does, depending on how the Fed reacts. I mean, the labor market has clearly slowed, right? Whether or not that number is a little higher or a little lower, we know it's slowed. You can see it. You see it in wage inflation. You see it in some of the claims data. It has slowed. And so the question is that slowing going to be met with more dovish policy? And then it's just a slowing and doesn't morph into something more significant. I expect it will, but we'll see.
Any sign of that coming from Chairman Powell?
As much as he's been locked in, I think I saw the first set of cracks at the testimony last week.
What stood out for you?
This idea that he, A, admitted that most of the committee sees cuts this year, and B, he seemed to hint that September would likely be in play unless we had a big inflation surprise. I mean, look, in a perfect world, I think it probably should be July, but if it's September versus July, that's probably not the end of the world.
Steve, it's good to see you. Constructive and right through much of Q2. Unexpected. A few months ago, being constructive and bullish this market in early April, that was dangerous stuff back then. Sounds great now, but that was a trade for the brave back in early April.
And now it's a trade for the prescient when you look back. And the question is really, can we continue forward with the same kind of momentum at a time where there are these big risks? And what Steve is pointing to is all those people who are still saying, are we too optimistic, are the reason why this market will continue to go higher.
Steve mentioned Chairman Powell. Chairman Powell will be speaking tomorrow in Sintra, Portugal, alongside a whole bunch of central bankers, so look out for that in the next couple of days. In the meantime, let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara Anand. Hey, Yahara.
Good morning, John. Senate Majority Leader John Thune is working to pass President Donald Trump's tax and spending bill by July 4th. But Thune is facing opposition from 8 Republican senators and must find a compromise between factions of his party. Some are pushing for deeper spending cuts, while others are seeking more funding for health benefits and renewable energy subsidies. Meanwhile, Canada is making a move to try to jumpstart trade talks with the U.S. It is withdrawing its digital services tax on technology companies such as Meta Platforms and Alphabet. This comes after Trump said on Friday he was ending all trade talks with Canada in retaliation for the digital tax. And online retailers Temu and Shein have seen user growth plunge after President Trump imposed steep tariffs on Chinese goods and ended the de minimis loophole. The Financial Times is reporting Temu's monthly U.S. active users plunged more than 50% to about 40 million users March through June. It reports the companies have switched their focus to Europe. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, the tax bill hitting some resistance.
I want to move on to the big, beautiful bill. Do you think you're going to get it in that timing?
Problem is, if we're 2 days late or 5 days late, everybody says, oh, he had a tremendous failure. Whatever it is, as long as we have it, it's very important.
Up next on the programme, we'll catch up with Terry Haines of Pangaea Policy and get you the latest from the nation's capital with Bloomberg's Tyler Kendall. Live from New York City this morning. Good morning. .40 this morning, 9:40 Eastern Time. Do not miss this conversation. The Treasury Secretary Scott Bessent sitting down with Bloomberg TV on taxes, on trade, on this market. In this market right now, equity futures positive once again by 0.4%, coming into Monday at all-time highs, and we had some weight to the rally on the Nasdaq, up another 0.65. Elsewhere, under surveillance this morning, the tax bill hitting some resistance.
I want to move on to the big, beautiful bill. Do you think you're going to get it in that timing?
I don't know. I mean, I can't tell you that. I hate to say yes. I'd like to say yes, but the problem is if we're 2 days late or 5 days late, everybody says, oh, he had a tremendous failure. Whatever it is, as long as we have it. It's very important. If we don't have it, there's a 68% tax increase. If we don't have it, the debt ceiling extension is very important.
It's the latest this morning. The deadline for President Trump's big, beautiful bill could slide as the legislation faces pushback from his own party.
We owe it to the American people, and I owe it to the people of North Carolina to withhold my affirmative vote until it's demonstrated to me that we've done our homework.
Joining us now to discuss is Bloomberg's Tyler Kendall. Tyler, good morning and welcome back to the program. Just how strong is this pushback from the Republican Party over the weekend?
Yeah. Hey, John. Good morning. Well, we know at least 2 Republicans who are likely no's, and that could serve a problem for Senate Majority Leader John Thune because he can really only afford to lose 1 more before he has to call in Vice President J.D. Vance to cast a tie-breaking vote. Now, one of them we just heard from, that's Senator Tom Tillis, a Republican from North Carolina. He's raised concerns about changes to Medicaid, including lowering the Medicaid provider tax, as well as how quickly some of these clean energy tax credits are going to be phased out. The second, as you see right there, is Senator Rand Paul of Kentucky, who wants to see deeper spending cuts and really won't vote for any legislation that lifts the debt ceiling. And that really illustrates the 2 factions here. Yes, they agree on sort of the core tenets of this bill when it comes to the tax cuts, but they are on completely separate ends when it comes to the spending cuts. And there's about 6 other Republicans that we are closely watching that are on the fence. And Senate Majority Leader John Thune is going to have to really get them over the finish line if they want to pass this by July 4th. Now, to give you sort of the stakes that we're working with, the Senate's going to reconvene today at 9 a.m. Eastern. They're going to kick off what's known as a vote-a-rama, where essentially Democrats are going to introduce amendments, try to force some politically fraught votes and drag out the process. That could take up to 12 hours to complete. But once it's done, then the Senate would vote on final passage, which, John, means the Senate could potentially look at passing this if they have the votes as early as tonight or tomorrow morning.
Tyler Kendall with the latest in Washington. Tyler, thank you. To build on that, Terry Haines of Pangaea Policy joins us now. Terry, in your opinion, is this real, authentic resistance or just a little bit of theatre before the ultimate inevitable later this weekend?
Good morning, John. I'm in the theater category, I think, today, and I enjoy theater, but it is theater. Political bodies always wrangle around for votes, and this is a situation where there are 53 votes that absolutely matter, and they're jockeying for the most they can get in a situation. But at the end of the day here, they come together, and if anything, the weekend saga with Senator Tillis foreshadows that, because you get a situation where, there was so much pressure put on him, he's decided not to run for re-election. These guys all like their seats, and they're probably going to want to stay.
Terry, when it comes to who has the leverage right now, when there are competing factions in the Senate, which group is it?
Fundamentally, I think it's the people that are kind of the harder core versus the softer. Obviously, there's more of them, number one. Number two, they're pushing as hard as they can to get this thing done. They will make whatever smaller accommodations they have to the other faction to get some things done. But don't look for the Senate to automatically morph into flip over to the soft side wholesale.
When it comes to how this legislation, this process all comes together, what is going on with the Baird rule? Do you think we're setting up a precedent now where any party can come in and basically set policy and extend that policy within the next 10 years?
Oh, I think that's been going on for 60 years through the reconciliation process, frankly. Let me also say on the Baird rule, the Baird rule is a germaneness rule, by which I mean, whether or not it should be, some provision ought to be in a budget bill or not, whether it has budget impact at all. And, those are rules of the Senate. And, I know there's all this kerfuffle about Liz McDonough, the parliamentarian, but what she's doing is faithfully executing her job as a staffer, the parliamentarian, to interpret and finalize rules that the Senate itself has put into place. So this is not a situation where the staff's hijacking some process, and it's a terrible thing for any elected official to blame a staffer for that sort of thing. This is a situation where the rules governing the particular budget process are in play. But back to your point, though, both parties have been gaming this system for 60 years, and I expect that to continue. Yes.
Terry, you said initially that you do think this is more theater than an actual fissure in the Republican Party that could stymie this bill. And yet we're all playing the numbers game over the weekend that the senators, the Republican senators can only afford to lose 3 votes. And currently there are 4 that are on the line. There's Ron Paul, Lisa Murkowski, Susan Collins, and now Tom Tillis, who isn't running for re-election, isn't necessarily constrained by potentially being primaried. Who caves on that front? Why do you see this as still getting over the finish line?
Because of the sequence of votes, generally speaking. I think what Senator Murkowski, Senator Collins get is a little bit of softening on Medicaid provisions, maybe some other things that they're interested in. Senator Murkowski is always standing up for Alaska Energy, and she should, and she'll work on that. And at the end of the day, what you're going to have then, once those accommodations are made, then you're going to have a situation where you have 52 on one side and Rand Paul on the other, and they will vote for final passage there.
So we spent a lot of time wringing our hands earlier this year talking about the increasing budget deficit in the United States and how this was going to cause some sort of bond vigilante moment where you get real pushback in the bond market. We just had the best month for the bond market in terms of performance going back to February. At the same time that the Committee for a Responsible Federal Budget says that this current iteration of the One Big Beautiful Bill is going to add $3.9 trillion to the deficit over the next decade. Which is it? Do you think that people are being a little overly sanguine about what this does to the deficit? Or do you think, like we heard from Steve Chiavarone, that there are going to be real offsets that we haven't accounted for?
Well, 2 things. One, whoever's doing the interview with Secretary Bessent, I hope they'll acknowledge that he was absolutely correct on how he thought markets would react in the medium and long term here, both on equities and in bonds. He called that, and a lot of people didn't. Secondly, sanguine, I don't know. The rules by which the CBO and outside groups concoct their views are artificial, and they exclude lots of things like the impact of tariffs and growth, frankly. So yeah, I'm on Team Steve on this one, I think.
Terry, when it comes to how this actually gets to the president's desk, what's going to happen in the House? Does the Freedom Caucus just fold like they did in 2017?
I've been for 3 months now been advising markets that this thing was going to happen on or around July 4th, and now here we are. And I've also for probably a couple of months now been advising that the whole purpose here is the Senate's going to jam the House, and the Senate bill will be the final bill. And I still think that. And frankly, if you listen, I mean, this is that buzz is kind of bubbling under right now. But if you listen to what the House people say publicly, they expect that. There's all kinds of talk about how we've accommodated the House and how we've been working together and all the rest. What that is a signal that we're going to end up having to take whatever the Senate does, and the president's going to have to come in and put the hammer down on some people.
Hey, Terry, it's good to catch up with you this Monday morning. Good morning, sir. Terry Haines there of Pangaea Policy. Is it real resistance or theatre? Terry believes it's just theatre.
Just theatre, but potentially there could be real resistance, I think, with some members in the House. I understand what Terry's saying. There is some good mood music put out there, maybe from the likes of Congressman Mike Lawler. They are keeping the SALT provisions in. But then you go to Chip Roy. Congressman Chip Roy of the House Freedom Caucus, you go to his Twitter handle over the weekend. He does not like this Senate version of the bill.
Speaking of resistance or lack thereof, Lisa, you talked about the bond market. Yields down for 3 consecutive weeks, down almost 10 basis points on a 10-year just last week.
People are shrugging off this idea that somehow this is going to spur bond vigilantes into action. They're going to come with pitchforks for Washington, D.C. and say, get your fiscal budget in order. We're not seeing it happen. And it raises this question, why? Is it because there maybe isn't as much foreign selling? And a whole host of analysts over the weekend suggested that's the case.
10-year bond yields this morning down 2 to 4.25. Up next, the former senior Trump trade advisor Kellyanne Shaw as Canada looks to restart trade talks with the US. Plus, Danny Berger with your morning movers, renewables in focus falling on the latest version of Trump's spending bill. Live from New York, you're watching Bloomberg TV. Coming into Monday, record highs on the S&P 500 through Friday on a two-day winning streak on the S&P, closing out last week for the biggest weekly gain since mid-May. Up another 0.4% on the S&P this morning. On the Nasdaq, up by 0.7. Switch up the board and turn to the bond market. 2-year, 10-year, 30-year. Nothing to worry about in fixed income at the moment, apparently. 3 consecutive weeks of lower yields on a 2-year and 10-year. The 10-year down by close to 10 basis points last week. Down another 2 this morning, going into payrolls Thursday, a few days away. Your yield, 4.25. As yields come back down, the pressure on the US dollar is not going anywhere. In the FX market, euro-dollar, check this out. The euro stronger for an 8th consecutive session. That grind continues, 117.23, the longest daily run going back to July 2023. Want to watch in the FX market? That's the cross-asset picture. Let's get you some single names. Your morning movers with Danny Berger. Hey, Danny.
Hey, John. Clean energy stocks getting slammed in this morning's trade. The latest release of the One Big Beautiful Bill having a quicker than expected rollout, phase out of those renewable tax credits for solar and wind projects. They're not going to end in 2027. The expectation is that would have happened later. So you're looking at names like NextEra Energy falling 3%, AES that's falling 2.5%. Also in the latest draft of that Senate version of the bill, you also saw a quicker rollback of EV credits or EV relief for those purchasing it. That's hitting Tesla this morning. Shares are down more than 1%. Elon Musk even taking to X over the weekend, slamming that tax bill. Finally, rounding things out with a little bit of sell-side action from you. Jefferies upgrading Disney this morning. Shares are up 1.9%, saying that there is less of a slowdown likely coming for their parks division. Cruises also look strong, and they have a really big slate of entertainment coming up over the next 6 months, including Zootopia 2 and Avatar 3, because nothing is new anymore. John.
Of course, that's just the way it goes. Danny, thank you. It's in the movies over the weekend, saw all the trailers. It's exactly how I felt. Felt like I've seen that. Seen that, haven't seen that, but I felt like I've seen that, and I don't need to see it anytime soon.
And often, you actually have seen it, because usually it's a 2, 3, 4, or 5 that is the iteration of a particular series.
Giving all of that a miss. On our radar this morning, one of our top stories, President Trump's tax bill heading for a marathon voting session in the Senate. The Majority Leader, John Thune, working to appease holdouts, needing at least 5 senators who are currently opposed to vote in favor.
So he can only lose 3, and he's pretty much already lost 2 with Tom Tillis and Ron Paul. Obviously, J.D. Vance will have to come in for one of those votes. So he needs to get one of these handful of senators over the finish line. Likely this is going to come down to the group what Terry was talking about, when those that looking to scale back how quickly they are cutting when it comes to Medicaid cuts. And that might be the reason why, because politically this might be challenging for Republicans when it comes to the midterms. And you already look at some of the research. Pew Research is showing that most Americans actually are not down with the One Big Beautiful Bill. Maybe in terms of tax cuts, but they don't want to see things like Medicaid or any sort of health care benefits being taken away.
So this is the reason why we're going to have a Votorama, which is going to be 12 hours or more. The rabbit hole I went down this morning was, why Votorama? How did they name it that? And evidently, as recently as 1992, they started calling it a Votorama. And in 1996, it was basically codified by Republican whip Trent Lott. So we've been referring to this thing as a Votorama, which sounds like a bad term out of a 1988 sitcom. So I was just wondering, and yet here we are.
Can I recommend that you spend that time next time just sleeping? Some extra time in bed.
I actually really enjoyed it.
You just get bored at about 4:30 in the morning.
It wasn't bored. I actually was thinking, how did we end up saying this with a serious face? Votorama. Every single time it comes up, and yet here we are.
We'll do it again all through this week. That's just one of the deadlines, by the way. That's July 4th and taxes. July 9th and trade very much in focus too, with Canada making a concession to the US in a bid to restart trade talks, dropping its digital services tax that would have cost tech companies billions of dollars. The Prime Minister Mark Carney and President Trump agreeing to sign a new deal by July 21.
So 2 things we learned from this. One, there is going to be an extension, at least when it comes to Canada and their trade discussions. When I speak to trade negotiators on the other side of the United States, if they are serious in conversations right now with this administration, they are being told from the Treasury Secretary, from Ambassador Greer, that we will give you that extension. 2, when it comes to just digital service tax, how much did this actually help Mark Carney? This was something from the Justin Trudeau world. And a lot of businesses have been going up to Mark Carney saying, please don't put this into play, and maybe President Trump actually helped him here.
Yeah, I actually think Mark Carney has to be given a little bit of credit. He has brought the temperature down in a significant way. Even when you had the leaders of the world come to Canada, he didn't have them come out with some sort of joint communique. Let's not focus on that. Let's talk about real stuff that needs to get hashed out and not sort of raise the temperature on a specific number of words. You have to say, he's kind of played this in a way that has made Canada more accessible for people who might want to vacation there.
The personalities, the substance, the weaker currency, all of that stuff.
Exactly.
Can I fit one final question in? Deadlines? July 21, July 9th, China's August. What's the real deadline for all these countries?
I don't think there is one, because the president continuously also says in 2 weeks. How many times have we heard there's going to be a trade deal in 2 weeks? I feel like I've been hearing that for 2 weeks, every 2 weeks since April 2nd. So I think it depends for each country. It's specific.
We'll come back to the trade story in just a moment. Let's get to the story here in New York City. President Trump threatening to withhold federal funding from NYC if mayoral frontrunner Zohran Mamdani, quote, doesn't behave himself financially. The comments coming as Mamdani says he doesn't believe the world should have billionaires.
And this raises this issue of the U.S. federal government versus local municipalities and their governments. You have seen this type of threat raised before. What I find interesting is there is a split right now in MAGA world about people who find this abhorrent and people who maybe aren't so much in that camp. Tucker Carlson over the weekend coming out and saying that Zohran Mamdani was the only person in New York City's mayor debate to say he wanted to focus on New York City. All the other candidates said Israel. I just think it's interesting to see this split, because if you start to look at some of the rhetoric, it starts to look very similar on either side when you go far enough to the fringes.
I saw that clip with Marjorie Taylor Greene, and she said, yep, he gave the right answer. He was the only one that said, I have no reason to travel anywhere but to stay right here in New York. We have seen the president do this before. He did it with Governor Newsom. I'm going to withhold funds if you don't do what I like to do. If Zohran Mamdani actually becomes the mayor of New York, that is going to be an incredibly tense relationship between Washington and the financial capital of the world.
And could be very complicating for that Democratic Party going into the midterms next year and trying to secure what their future looks like into the next presidential general.
Absolutely, because a lot of Democrats that are more moderate, that are more, I would say, centrist of their party, have come out really strong against Mamdani and have actually also, some of them said, I'm not ready to give my backing to this individual.
That's the latest on New York City. The countdown to that election in full swing. Let's get back to trade. Global trade partners looking to strike a deal before President Trump's self-imposed deadline on July 9th. The former senior White House trade advisor Kellyanne Shaw writing the following: I'm expecting to see most tariffs land between 10 to 25%. Kellyanne joins us now for more. Kellyanne, welcome to the program. What leads you to that conclusion, Kellyanne? 10 to 25?
Thank you so much for having me. And I do agree with Annmarie. I think July 9th is feeling less like a deadline and more like a mindset in terms of how I expect to see some of these relationships roll out. I think that 10% is the safe zone. That's where the president has kept us for the last almost 90 days. And 25% is a really high tariff. So I expect after all of these negotiations that the countries who get the best deal, like the UK, will end up with a 10% baseline tariff. And my expectation is that for everybody else, 25% is probably the upper range. Plus, we have some of these sectoral tariffs, and we're getting some of those indications from administration officials who are signaling that to the private sector as well.
I like that. It's a mindset. So in this negotiation of mindsets with all of these countries, what is the order, the pecking order of who gets a deal first?
Well, I think we're likely to see a mix of countries. And clearly, the administration has been targeting our biggest trading partners, those with whom we have the largest trade deficit, as the prime targets for the president's trade policy, because if you get that right, everything else can flow through there. But what I expect to see is actually a mix. I think we'll see some large trading partners. I'm actually starting to put the European Union in that bucket. The president's talked about India. We could see some Asian countries as well, Latin American countries, other European countries like Switzerland. Maybe we see Brazil, Argentina, and countries like Israel in there. And then the president is going to assign a tariff rate to everyone else and give them the opportunity to come back and to renegotiate if they want something lower. So I think we'll see all of the above.
So it feels like he'll just be negotiating for his entire term. Is that how you take it?
Well, if it's anything like Trump 1.0, then yes, I think this is a perpetual negotiation that we'll continue to see unfold. But here's what I really think we'll see, that over the next couple of days, starting with July 4th and rolling into July 9th, we'll see a series of deals announced. And these will effectively be like agreements in principle over some core obligations. And then the details of those deals will need to be further negotiated. And Secretary Bessent has talked about Labor Day as a potential target date for finishing up some of those negotiations. And I think we'll see more stability in the market from there. But this is continually a moving target. And I think countries who want a better deal 6 months, 2 years from now will have the opportunity to get that.
So let me get this straight, Kellyanne. We're talking about July 9th soft deadline for concepts. And then for some more details, we're talking about Labor Day. What do companies do with all of this? I mean, are they paying the de facto tariffs at any given time? How do they sort of follow rules that have not yet been codified?
Yeah, I think those are really great questions. And I do think that we'll start to see a lay of the land come July 9th. And I think we'll see a greater lay of the land come this summer, fall. And that's where I really think the private sector is going to have more certainty as to what some of these tariff rates are likely going to be for the long haul. But I don't think we'll ever get that certainty because we also have these sectoral tariffs that the administration is continuing to roll out. We've heard that they have 6 or 7 more investigations in the hopper of different products and sectors. So I think we'll continue to see this evolving, but I do think we'll get more certainty through the summer.
So there's been this theory out there that we'll see some of the trade negotiations and the trade deals that we've been discussing trickle into the economic data and trickle into earnings as soon as the next few weeks. Do you think that's feasible given the fact that companies don't have certainty and aren't willing to make big moves on either a supply chain level or even on a pricing level before they have that clarity?
Yeah, and I think the other thing that's in play right now is the one big beautiful tax bill. And so what the administration would say, of course, is that it's not just our tariff policy, our trade policy, but you have to look at our tax policy, deregulations, energy diversity, all of these things to get the full picture as you're taking steps to invest in the United States and set up some of those supply chains. But I think for some of these sectoral tariffs, those are going to be stickier. So companies who are in steel, aluminum, automotive, semiconductors, pharmaceutical products, I think they'll see some more certainty sooner. But I do think for everyone else, if you can sort of bake in an estimate of a 10 to 25% tariff, depending on where you're importing from, that's probably a good estimation of where things are going to land. And that's what I'm telling my clients.
An entire trade conversation. We haven't talked about China yet. Kellyanne, just what's the next steps when it comes to this relationship between Beijing and Washington following the Geneva and London talks?
Yeah, I think things are going very slowly at the moment. And so right now we are working on implementing that original Geneva deal through the London framework. And so all eyes are focused on some of these export controls. On the Chinese side, rare earths and rare earth magnets in particular. On the U.S. side, some of the countermeasures that were taken. The president mentioned yesterday that the chokehold the U.S. has is on China's aircraft and aerospace industry and that they need us for that, the same way we need them for rare earth magnets. So I think we need to see a de-escalation with these two sectors right now in the next few weeks. And at that point, that August 12th deadline was supposed to be the date where we saw a broader set of economic commitments being negotiated between the United States and China. But I do think the focus of August 12th is going to be relatively narrow, both on implementation and maybe seeing phase 1 roll out. But this is going to be a difficult relationship. And I think we're going to see this play out over the next year or two, not just the next couple of weeks.
Kellyanne, a few more years of this. Can't wait. Kellyanne Shaw, the former senior Trump trade advisor. I'm not sure the market can cope with that, which is why the market's just started to ignore it all over the past 2 months.
How do you price in tail risk? Because every day seems catastrophic and every day doesn't materialize anytime soon. It just, you ignore it. And at a certain point, that's the only way to stay sane.
This is the biggest wrinkle in communicating policy at the Federal Reserve at the moment. The Fed chair gave his semi-annual testimony. He said, who's going to pay the tariffs? Who's going to pay the tariffs? Really, what he should be asking is, what are the tariffs? Shouldn't that be the number one question right now?
And that's the reason why he said he had to wait until July 9th to understand the levels. Does he get those levels on July 9th? And if it still is an ongoing negotiation, how much do you end up in a situation where we don't have any sense of it and we're just throwing spitballs at the wall like we've been doing all year?
Kellyanne Shaw was at the table and negotiating with China when it came to the phase 1 trade deal. When she says July 9th is a mindset, I take her word for it.
Did you used to make them as a kid? Put them in straws?
You know, I was actually jealous.
Disgusting.
I was jealous of the people who could. Actually, they are kind of disgusting. But
no, it's vile. It just took me back.
Did you ever do it?
I'm sure I did.
Yeah. I did not. I do not comment.
I haven't thought about that for about 30 years.
Yeah, people also used to do other things, like wet things and throw them at the ceiling.
Talk about that another time. All right. Futures at the moment on the S&P. Markets, what were you doing last week? Social media stocks. Equity futures positive by 0.4% on the S&P. Nice. On our radar this morning, a lot on trade, taxes and policy. In the news this morning, in our Bloomberg brief, Yahara Anand has more. Hey, Yahara.
Hi, John. One of Hong Kong's last remaining pro-democracy parties has officially disbanded. The leader of the League of Social Democrats cited immense political pressure for the decision. It's the latest opposition party to cease operating after Beijing imposed a national security law on Hong Kong in 2020. Meanwhile, here in the U.S., North Carolina Senator Thom Tillis won't seek re-election. This coming after Tillis voted against advancing Trump's tax and spending bill. Trump responded on social media, calling Tillis a talker and complainer, not a doer, and said he was speaking with several candidates to launch a Republican primary bid. And Meta is ramping up hiring for its AI superintelligence group. The company signed on 4 notable AI researchers from OpenAI. Meta CEO Mark Zuckerberg made headlines this month for beginning to personally recruit AI researchers and engineers after being frustrated by his company's shortcomings in the space. I guess those $100 million pay packages are working. That's your Bloomberg brief. John?
Yahara, thank you. If you can't buy the companies, take out the stuff.
And frankly, that seems to be what he's doing. And remember when we were talking about social media stocks? Just saying.
In the news.
Exactly. And this is the way people are spreading political messages, messages about Photoramas.
An aggressive push from Mark Zuckerberg. You're taking that somewhere else. Up next on a program, a Thursday payrolls report.
What if we're transitioning now to a point where the labor markets are becoming a source of disinflationary pressure? And the reason that could be is because the stock of unemployed people continues to grow.
Up next on a program, Aditya Bhave of Bank of America. His number for Thursday morning in the 90s. That conversation up next. All-time highs into Monday. Equity futures, the rally continues. This quarter has been an absolute blur. Where's it all gone? Equity futures this morning up by 0.4% as we close out Q2 and the month of June. Under surveillance this morning, a Thursday payrolls report.
What if we're transitioning now to a point where the labor markets are becoming a source of disinflationary pressure? And the reason that could be is because the stock of unemployed people continues to grow. The markets, I think, are still looking for a smoking gun. And, to me, that could be a negative payroll print at some point over the next few months. And when that happens, I think the markets will begin to price in more rate cuts.
Here's the latest this morning. A shortened but busy week of economic data ahead, including ADP, JOLTS and the June jobs report. Aditya Bhave of Bank of America writing the following. We expect June non-farm payrolls to come in at 95,000, lower than the consensus expectations of around 120. Aditya joins us now for more. Aditya, good morning. Good to see you.
Good morning. Thanks for having me.
So we've got lots of questions. You're looking for something like 95, but then no rate cuts for 2025.
Correct.
Lisa's got the Fed questions. I'll stick to the data. 95. Is that a bad 95 or just 95 and get used to it?
So the first thing I'd do is focus on the unemployment rate. I think that's more important than non-farm payrolls because payrolls are affected by both supply and demand, and the Fed has been pretty explicit about this. But with the unemployment rate, we think it'll land at around 4.3%. In May, it was 4.24, so that's fine. On payrolls, we think it's a combination of some idiosyncratic stuff around the timing of Memorial Day and how that affects leisure and hospitality hiring in May versus June. So basically, we expect some payback, but also structural issues, right? So continuing claims were quite elevated in the survey week for June.
Well, combine those two data points. Don't they paint a picture of deterioration in the labour market?
Softening, yes. Outright deterioration, I think we'd worry about that more when the unemployment rate goes above 4.5.
So John and I had the same question. We read your report. We saw your call for the Fed, no rate cuts. And we both said, square the circle. How can you possibly have a deteriorating labor backdrop, albeit not necessarily weak, and a Fed that remains on the sidelines without any real inflation pressure, as we've just seen in core PCE?
So that last part is what I would question. I think there is some inflation pressure. We've been stuck at 2.7% for the last year on core PCE inflation. In May of 2024, the core PCE was 2.67%. Now it's 2.68%. The excuse last May was that housing inflation was going to come down, and that was going to bring the core back towards 2%. Well, that's actually happened. We've gone from 5.5% to 4% on housing, but everything else has picked up, particularly goods. Right? So we're not actually making progress on inflation even before you see the bulk of the tariff impact.
So what are you seeing right now that Mary Daly, Jerome Powell, and so many others aren't, where they're even signaling that September is the time that they're going to cut rates and it is fully priced in markets? What are you seeing that you think will surprise them into holding?
So I think September is live in the sense that it's an option, and that's the way they're setting it up, because they're concerned about how the labor market will evolve over the next 3 months. And indeed, if the labor data are super weak over the next few months, if we get to 4.5% on the unemployment rate, I think it's completely reasonable for them to cut in September. The problem is if we don't, then you're looking at potentially 3% core PCE with a still relatively healthy labor market, and then I think it gets a lot harder to cut. And when you get into the fall, you're talking about fiscal stimulus kicking in, we're getting past peak tariff uncertainty, and the economy could pick back up again.
To John's point earlier, how important is it for the Fed to understand not just who's eating the tariffs, but the tariff rates? And we might not get that by September for all these countries.
Presumably, we'll have a lot more clarity after the 9th of July, but you're right. I mean, things could still go back and forth.
How are you drawing a conclusion right here, right now, about who is going to shoulder the tariffs? We've had two different types of guests come on this programme. I've read from Goldman Sachs, who say it's going to be the US consumer, the US companies. We've seen from other companies, including Federated and Steve Orth, who thinks it's going to be the exporter. It's going to come from the international players that have to absorb it and take it on margin. Have you seen anything in the data right now that convinces you one way or the other?
So I would start with the idea that back in 2017-18, FX actually ate most of the shock, right? So the renminbi adjusted against the dollar, and so it was neither the exporter nor the importer nor the consumer that was paying it. That hasn't happened this time around, so someone's got to pay it. And it's probably going to be a mix. If you look at import prices, they do suggest that it's going the U.S. importer and the consumer will have to bear a significant burden of the tariff.
This is the ultimate question then. Is the consumer in a position to bear the ultimate cost of the tariff? Are they in a position to go back to their employer and ask for a wage increase? And that's where the pushback is at the moment. And we hear it from economist after economist. The tightness in the labour market just isn't there. They're not able to go there and ask for those higher wages. They won't be able to back this up. And therefore, you shouldn't worry about inflation getting out of control. Why doesn't that convince you?
Because the saving rate has actually increased quite significantly. So the trough of the saving rate back in 2022 was 2%. Now it's 4.5%. So in theory, if you just take that literally, that means that we have room to absorb about a 2.5 percentage point inflation shock. Nobody's talking about that big of an impact to consumer spending, right? We're talking about inflation rising by a few tenths, maybe several tenths. And I think again, in theory at least, that could be eaten by the saving rate.
And this is why the debate continues for the summer.
Because some people say the savings rate, you can look at just the fact that a lot of consumers are under leveraged and they could add some more with respect to credit card bills. I just wonder whether it just ends up being company specific. Nike was able to pass along more of the prices. General Mills, turns out Lucky Charms isn't as popular for breakfast anymore as it was when I was a kid. So it's sort of this company by company, who has the pricing power to actually carry it through?
Not a tariff story, though, right?
Well, it's both.
The cereal story, I'm talking
about. That's a Maha story. Make America healthy again.
Yes, but it's also, I don't know what exactly it is. My kids don't even like it.
You're saying company after company, they're going to take out the artificial dyes?
Yeah, although I can't imagine Skittles without artificial dyes. Like, what do they look like? Just sort of like vague.
You can use beetroot extract. You can use beetroot extract. You don't need to use Red 40.
I know what you think.
Is it RFK making America healthy again? Is that what you said?
Well, yeah, I think he wants to be the chief nutritionist.
There you go. We're seeing that change. Aditya, it's good to see you. Thanks for dropping by. Not going to ask you about that, don't worry. The second hour of Bloomberg Surveillance is just around the corner. Live from New York City, you're watching Bloomberg TV.
I think that there is a structural decline in the US because there are genuine questions about the reliability of the institutions.
Base case, actually very in line with what the Fed has said, is a slowdown in growth below potential, but still positive, and slightly higher inflation.
There's a little bit of almost an over-optimism that rate cuts are coming imminently.
The next 6 to 9 months, I don't think rates are going to be dramatically lower.
We were expecting, okay, the noise is going to quiet out through the summer, and now I'm not so sure.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
What a rally through Q2. It's the final trading day of the second quarter, and so far in Q2, we're higher by 10% on the S&P 500. Your scores this morning look like this on the S&P. Equity futures up again by 0.4%, building on a two-day winning streak on the benchmark stateside. On the Nasdaq 100, higher by 0.6%. Your week ahead shaping up as follows. Full of economic data, the big one on Thursday. Payrolls Thursday before the July 4th holiday. And then, before we get to all of that on Tuesday, we hear from Chairman Powell at the Sintra Forum for the European Central Bank, and Chairman Powell is not looking to cut rates anytime soon.
And frankly, he's the difference between the bulls and the bears right now. A lot of people saying that if the Fed does cut rates for the right reason, which is that inflation's coming down, but the economy isn't falling off a cliff, you end up with a rally that's even more significant than what we've seen, taking stocks back to an all-time high. If they stay put, like we just heard from Aditya Bhave, some people think that maybe some of the froth comes off the top, given the fact that valuations really get challenged.
Before he sets policy, he's got to work out what policy is elsewhere. July 4th for taxes, July 9th for trade. And as we've said repeatedly already this morning, both those self-imposed deadlines might slide.
They might slide, and the president himself has said it might be a few days late when it comes to the one big beautiful bill. When it comes to the trade agreement, already we see from a statement from Canada that they already have a new deadline, July 21st. So it really depends what country you're coming from, what deadline you're going to get when it comes to trade negotiations. When it comes to the one big beautiful bill, today's important. Senator Majority Leader John Thune's bringing everyone back at 9 o'clock. Anyone can have an amendment to your vote-a-rama. And basically, this could be hours in the making. And he's really doing all the dirty work behind the scenes. He has a number of senators he needs to shore up, basically dealing with three factions: the fiscal hawks, those that want to see more benefits for Medicaid and health care benefits, and those that are saying you're going too far on the renewables. We need to keep them. If they were able to get this over the finish line in the Senate, and that might take some time, does the House just capitulate and accept this? That's a big question.
The pressure's coming from within the Republican Party. It's not coming from the bond market right now. And Lisa pointed that out in the last hour. 10-year bond yields at the moment around 4.25. And it's not like this has just happened over a few days. This is 3 weeks now of lower bond yields, and last week down another 10 basis points.
Yeah, this is right now you're seeing yields get back down to places that we haven't seen since February after the biggest rally in bonds going back a couple of months. There's a real question here. Have people just stopped caring? Have people looked at the dynamics and seen inflation coming in, even with some sort of risk premium? Or is there just a great degree of complacency at a time when you have the Committee for a Responsible Federal Budget coming out and saying it's going to increase the deficit by $3.9 trillion over the next 10 years? I'm not sure what to make of this, except that maybe supply isn't what's driving bonds right now.
I think it's fair to say that the Treasury Secretary, Scott Bessent, might be happy this morning with this outcome. He's going to join us later on this morning, 9:40 Eastern Time. Look out for that conversation right here on Bloomberg TV, a conversation with the Treasury Secretary, Scott Bessent, at 9:40. That's coming up later. Coming up this hour, we'll catch up with Stuart Kaiser of Citi, with stocks notching a new record high. Angelo Zino of CFRA, with Nvidia approaching a $4 trillion market cap. And Kurt Reiman of UBS, with President Trump's big, beautiful bill stuck in Senate purgatory. We begin this hour with stocks higher after the S&P 500 posted its first record high since February. Stuart Kaiser of Citi writing valuation, positioning, sentiment and risks are very similar to January as investors grow comfortable with no risk. Stuart joins us now for more. Stu, good morning.
Good morning.
Compare now to back then. Are things better now than they were back then?
Better. That's a loaded question. I would say better in the sense that the risks are known, and once the market kind of knows risk, they can deal with it. But I would say the risk to the economy, the risks from trade are, I would say, worse than they are in January to some degree as well. So I think the headwinds for the economy are probably a little bit worse right now. Market expectations and market understanding of those risks probably better than it was back then.
So you think that right now the market is fairly pricing some of the risks that come from a weakening economy and potentially trade deals that do increase tariffs between 10 and 25%, as Kellyanne Shaw said?
I mean, you'd hope the market is factoring that sort of level of tariffs into the math. I think before you just said good news is good news, right? You said if rates are lower for the right reasons, then the markets are going to rally.
You put words in my mouth, but go for it. Carry on.
No, look, I think the market's probably fairly discounting what they think a baseline for the budget is and a baseline for tariffs are. Are they fully discounting the unemployment rate, at 4.4% on Thursday, which is what our economists think? Probably not. So I don't think we're probably fully discounting the downside risk to the economy at this point.
There was a lot of uncertainty in January. You seem that same level of uncertainty right now, these July knowns, but still a lot of unknowns on the table?
I mean, look, it's if you go back to January, you're way ahead of April, right? I mean, back in January it was, Trump hasn't been inaugurated yet, and, we've got DeepSeek and things of that nature. So I do think the risks or the uncertainties right now are pretty similar to where they were in January. They're nowhere near where they were in kind of March and April. So it's been a long year, I guess. I mean, it's been a long quarter. We've had clients say, hey, well, what happened in 2Q? And I mean, the list is pretty long.
Go just back to January like a full circle, because in January we all were expecting a 10% baseline tariff and then higher, maybe 30 to 60% on China. Isn't that almost where we're going to end up with now, after we almost went through this process of, I would say, as Trump maybe would say, getting it out of his system when it comes to Liberation Day?
No, I think that's exactly right. You're kind of pricing a base case on tariffs and things like that, and on taxes as well. I mean, the market's expected those tax cuts to get extended for the whole year. What's different is you spent 3 months beating up the economy. And I think the question is, from here, is the economy, resilient enough to recover through that, or are you in the same place in January, except that you sort of bludgeoned the economy into submission to some degree?
That's a huge question. Is the bad data still ahead of us? Now, you've got to think about things super tactically. Going into something like payrolls on Thursday, are you comfortable being long into that event?
I think risks are to the downside for Thursday in particular. I think it's going to be a low-volume trading day. Our economists are at 85K payrolls with a 4.4% unemployment rate. If that number prints, I think we're lower from an equity perspective. So, tactically for that day, no, I wouldn't want to be carrying a lot of risk into that, especially ahead of a long weekend. And, Trump has a history of kind of messing up people's weekends. So, you've got those two things going on. Big picture, yeah, I mean, we're comfortable being long U.S. equity risk. We do it through a more high-quality lens, just given these uncertainty. So, yeah, very tactically, I'd be cautious around that payroll sprint. Next couple of weeks, probably okay being long equities in that environment.
How scary is it to be bearish right now? And I say this, how scary is it to come out with something that isn't just, ride the melt up? That is the biggest risk, pain trade. This idea that bears have gotten blown up time and time and time again. People who looked at the headlines and said, ooh, this bad. Not so much. Turns out it isn't so bad. I mean, how much is that scaring people away from tactically turning negative?
I think it's a great question. If you were short in early April, for instance, I mean, you just got destroyed on the way up. And consistently speaking, the tail risks have been trimmed off and the worst cases have been walked back. And if you've been short, that stuff has really worked against you, right? I think for a short or a bear to be happy these days, they really have to be betting on U.S. economic data weakening or a significant re-escalation in the China-U.S. trade war situation. So I think you need Trump to come out and say, they're not negotiating in good faith, we're going back to 100%. I think you need something to that degree to turn tariffs from a buy the dip opportunity into I need to sell.
What about on the flip side? What do we need to see on the economic data front that would cause the bulls to get even more bullish, for there to be a more fully broadening out in the rally that a lot of people have been waiting for, to say, okay, now we're actually seeing something that's sustainable?
I think it's exactly what you described earlier, which is you get a couple of rate cuts, not because the economy is slowing, but because inflation's coming off and the economy is kind of moving along in this late cycle kind of sideways fashion. And then you're doing $1 trillion of buybacks and you've got systematic buying and you've got foreign investors re-engaging in the U.S. So there is a story there. And it's just what you described. It's the economy kind of holds in, and we get a couple sort of supportive rate cuts behind that, with Trump promising more next year. And then the market, I think, can rally pretty well into that environment. So it's the economy at this point, I think.
Could you just clarify your bullish posture with a little bit more detail? I assume it's not just get long Mag 7, load up on big tech. Is it something a little bit more nuanced?
Yeah, I mean, I think it's quality across the board. So it's not just tech. We actually like semiconductors as a quote unquote catch-up trade. I know it doesn't feel like a catch-up trade, but it is an area that's actually underperformed in the analog semi space. So not just your NVIDIAs and your Broadcoms like the other folks. So yeah, it's kind of quality across the board. Mag 7 falls into that category, so it kind of gets swept up in there. We've generally liked large cap growth, as you know, for most of the year. We kind of backed off on that a little bit when rates started to dislocate to the upside. So we're kind of in a higher quality kind of, rate insensitive, stock right now.
There was another consensus sector long coming into 25, and I don't hear much about it anymore, but it was the banks. Everyone coming into 25, everyone sat in your seat. What are you long? We love the financials. What do you like? We love the banks. Where are the banks now?
Yeah, I mean, we would probably would have fallen into that category ourselves. We've actually seen quite a bit of demand for regionals and smaller cap banks for the last couple of weeks. And I think that is folks that like the banking sector, think the economy is going to kind of pick up a little bit and are looking for this laggard as we get to all-time highs. Look, you've got earnings coming up. You had the SLR. You're going to get potentially CCAR, later this week into next week. It's just going to remind people that financial is the second biggest buyback sector in the market as well. So you have a flows dynamic, you have a regulatory dynamic, you have growth holding in, you potentially get a steepening yield curve. You can quickly talk yourself into this being an environment that's very good for banks. I think the question is, within banks, what do you own? Are you hiding in those big, high-quality, large-cap folks, or are you willing to kind of go down cap spectrum, play more of an M&A theme, play more of a small-cap catch-up theme? I think we'd probably, at this point, still be comfortable in that larger cap, higher quality. But, it'd be dishonest for me to say that clients are not trying to engage in those smaller cap stocks right now.
To that exact point, I was actually looking at a series of statistics that Dan Curtis of Bloomberg puts out on a daily basis, and he was talking about how the volume of IPOs that have started trading so far this year is actually the greatest going back to 2021, 2022. Are we going to see an ongoing momentum in that space that a lot of people have now written off as being a lot more subdued than initially thought at the outset of 2025?
I mean, I certainly hope so. I think the M&A cycle was just a huge part of the thesis coming into this year, that you have an administration that's maybe a little more open-minded about M&A and things of that nature. And we've seen it. I would put, M&A, I would put that in what I would call institutional risk sentiment theme. Most retail investors are not trying to identify M&A targets, right? This is more of an institutional hedge fund trade. And when you see, our M&A targets basket has just been a rocket ship to the upside because, I think institutional risk sentiment has improved so much that people are willing to put money to work there. Whether it happens, I don't know. I'm sure you're going to hear in 2 weeks from most of the investment banks that the pipeline looks great, et cetera, et cetera. What's that?
Oh, yeah.
Yes, for a couple years, right? I mean, so look, we want that trade to work because that is an institutional positive risk sentiment, markets moving higher type theme. Will we see it? I don't know. I mean, we've had a couple very successful IPOs, but you need to kind of stack those on top of each other, I think.
The C-suite's just been aggressively whipsawed over the past 6 months or so. We came into 25 and you had this really sort of proactive, confident posture in places like the World Economic Forum in Davos, Switzerland. Fast forward a few months, April, it was sit on your hands and wait.
Honestly, we should do a basket for the anti-Davos sentiment and have people trade it in January and see how well it does every single year, because pretty much American exceptionalism, Europe needs to get off its can, let's go, this whole mood. I mean, every single year without exception. And this year was no different.
Confidence of American bankers right up here.
I mean, the highest
to start 25. And I guess all-time highs in the equity market might justify that to some extent because here we are. Equities at all-time highs this Monday morning. Stuart Kaiser of Citi is going to be sticking with us. Futures up again by 0.4% on the S&P with an update on stories elsewhere this morning. With your Bloomberg brief, let's cross over to Yahara Anand for more. Hey, Yahara.
Hi, John. Senate Majority Leader John Thune is rushing to meet President Trump's July 4th deadline to pass his massive tax and spending bill. But Thune is facing opposition from 8 Republican senators and must find a compromise. Some are pushing for deeper spending cuts, while others want more funding for health benefits and renewable energy subsidies. Meanwhile, Zohran Mamdani, the presumptive Democratic nominee for New York City mayor, says billionaires shouldn't exist. In an interview yesterday, Mamdani said it is so much money in a moment of such inequality. President Trump threatened to pull federal funding from New York City if Mamdani becomes mayor and, according to him, doesn't do the right thing. And President Trump says he found a buyer for the U.S. operations of TikTok, but won't provide details for, you guessed it, 2 weeks. Trump said it's a group of very wealthy people, but the deal will need China's approval. Trump says he expects President Xi Jinping to agree to it. That's your Bloomberg Brief. John?
Talk about purgatory. this company's just sort of in this rolling 90-day extension.
Yeah. And now it's
forever, it seems.
Yeah, it's sort of, is it going to be killed? Is it going to die in the United States? Well, 2 weeks. Just wait 2 weeks, and that's sort of where we are again.
Perennial extension for TikTok. But the fact of the matter is, you got to have China on board to be willing to sell this. And that's really the problem. I don't think having the buyers that want to buy this is the issue.
Yahara, thank you. More from Yahara in about 30 minutes or so. Up next on the program, the struggle to strike a trade deal.
What I want to do is, and what I will do just sometime prior to the 9th, is we'll send a letter to all these countries. We'll send a letter and we'll say to shop in the United States and you'll pay a 25% tariff, and we wish you a lot of luck. And that's the end of the trade deal.
Thank you for your attention to this matter.
Yeah. I love that.
Bottom of each letter.
Signed,
Yeah.
President of the United States of America.
Up next on the program, Tyler Kendall's going to join us next to break down the situation going into two key deadlines, July 4th, July 9th for taxes and for trade. Live from New York City this morning. Good morning. Looking to close out the quarter with equities at all-time highs, up another 0.4% on the S&P 500 on the quarter so far, higher by something like 10%, the biggest quarterly gain for the S&P 500 potentially going back more than a year. For the FX market, totally different story. Euro-dollar has had an 8% move over the quarter. Lisa, the worst quarter for the dollar against the euro back to December 22.
And I'm old enough to remember when people would point to this and say this was the end of American exceptionalism. The new trend has been this is the beginning of FX hedging desks across the United States, because ultimately this is all of the institutional investors from overseas saying, oh, the dollar might be a risk. We better get on that. It isn't necessarily coming from outright selling.
Jim Zouter of Apollo on the program just last week saying look to the earnings from the financials later on in the quarter to speak to that theme.
And that's ultimately what we saw with a number of studies over the weekend, in particular from Morgan Stanley, that looked at some of the tick data, the Treasury data that came out last week, and said you're not actually seeing outright selling. If anything, you are seeing net buying of U.S. stocks and U.S. bonds.
Euro-dollar 117.25. Out of surveillance this morning, it's the struggle to strike a trade deal.
What I want to do is, and what I will do just sometime prior to the 9th, is we'll send a letter to all these countries. There's 200 countries. You can't talk to all of them. We'll send a letter and we'll say we consider it a great honor, and this is what you'll have to do to shop in the United States. We're like a department store. To shop in the United States, and you'll pay a 25% tariff, and we wish you a lot of luck. And that's the end of the trade deal.
It's the latest this morning. Trade partners lining up to strike a deal before President Trump's July 9th tariff deadline. The White House saying agreements with as many as a dozen countries are expected by next Tuesday. Joining us now to discuss is Bloomberg's Tyler Kendall. Tyler, not all countries will be treated quite the same. So who's at the front of the line going into next week?
Yeah, hey, John. Well, a person familiar tells Bloomberg News that the U.S. actually is nearing some sort of agreement. We would expect these to be frameworks, not fully fleshed out deals with a few different economies. That includes Taiwan and Indonesia. They also say that pacts are possible before July 9th with Vietnam and South Korea. Now, that's not necessarily surprising, since we know that this administration has long prioritized those economies that are geographically close to China. Now, we'll have to see actually how this does come into effect, as the administration has said. On one hand, we could expect a handful of deals before July 9th. But then, as you heard President Trump there, he has long toyed with this idea of setting an effective tariff rate and letter set to our trading partners. And perhaps July 9th really could serve as the deadline for him to actually do so. It was interesting to hear the former Trump trade official Kellyanne Shaw say earlier on this program that she is expecting perpetual negotiations under this administration. And I will point out that it's been really fascinating to see how sector-specific tariffs have also made their way into these conversations in such a meaningful way, considering that our original understanding was that these levies enacted under Section 232 on the grounds of national security concerns were not going to be up for negotiation. But then, John, you had President Trump over the weekend threatening to keep auto tariffs on Japan at 25% amid a roadblock in those talks, giving us some insight into how this administration is playing with a lot of different factors here as they try to work towards some sort of progress on trade deals.
Tyler Kendall down in Washington, D.C. Tyler, thank you. Stuart, Kaiser of Citi, still back with us. Stuart, we've heard a few people say that the outcome of July 4th and that deadline might inform what happens on July 9th. Do you see it that way?
Not necessarily. I feel like those are kind of independent, from one another. What you get on July 4th may reference tariff revenues as a way to sort of justify a larger deficit. But I don't know. I feel like you're negotiating with July 4th is within the GOP negotiation. This other is negotiation with other countries. I think they're relatively separate, though. I do think, frankly, expectations are pretty high for both at this point. I think markets are assuming a budget deal will get passed with a pretty high likelihood. I think they're assuming all the tax cuts will be extended. And on the tariffs, I think they're assuming that you'll have the vast majority of these deadlines, either an agreement reached or rolled out because of good faith negotiations, and you'll probably get one or two countries that are used as an example to kind of prove that Trump is still serious about that. But I think both of those outcomes are probably net positive for equity markets.
Expectations are high that it gets done, but are they high enough that it gets done on July 4th and July 9th?
Yeah, on July 4th, I think most people are assuming July 4th, to your point, may get pushed a bit, but it's not going to get pushed into August, right? This is going to be something where they have a framework of the deal and they're sort of moving chairs around on the Titanic, as you would say.
When you talk about deals getting done, do you mean every single country but China?
It's a great question because you could argue that a lot of people assumed it would be negotiate with our trading allies first and then everybody negotiates with China as a bloc. He's kind of thrown that upside down, right? He's kind of done an end around and negotiated with China initially, which you might argue undercuts the leverage of countries like India and Europe in their negotiations with the U.S. So I think initially the assumption was allies first and then China, but it's a little hard to figure it out right now because that order has kind of been thrown up in the air a little bit.
Tyler brought up a good point. Sectoral tariffs. We haven't seen them yet, and these will have what many analysts say and lawyers say a lot better and solid legal footing. Are you concerned what that could mean from an equity perspective?
Yeah, definitely. Depending what sectors you're targeting, obviously, semiconductor tariffs are going to be an issue. Potentially stuff in the healthcare sector, I think can be a big issue as well. So, yes, but right, these get rumored, the markets move, and then they get kind of rolled back. So, yes, we're definitely concerned about it. Not necessarily because they're more legally defensible, because I don't think most investors have any idea what the legal grounds for a lot of this stuff are, anyway. But yeah, I think to your point, the good part about the sectoral tariffs, though, is it's much easier to trade, because you can trade the sector in those stocks directly. These big, broad-based, across-the-board tariffs, it's basically just a beta 1 sell markets. It's not, it's not as nuanced, it's not as specific and targeted. So I actually would prefer to have to trade sectoral tariffs than bigger, broader-based ones.
Are we understanding the margin compression that comes with tariffs that can't be fully passed along in terms of the price increases to consumers?
Potentially, but the dollar's weaker, so those earnings are going to repatriate at a higher rate. So we're all good. Look, I don't think we really know what's going to happen with margins on a go-forward basis. Nike's call last week, it actually sounded like they were going to basically eat margin a little bit, or maybe they were going to try to pass on cost. It was a little hard to determine based on their forecast which way they were going to go. I think a lot of these companies don't know themselves because they don't know what the tariff is going to be on Vietnam vis-a-vis Taiwan vis-a-vis Korea. So, your supply chain is also kind of in flux, I think, for a lot of these companies. So I don't think there's a clear understanding yet of what the impact is going to be on margins, which is why 2Q earnings should be so important, right? These companies were given a pass in 1Q. Will they be given a pass again if they don't provide that level of detail?
If you're long stocks, can we just finish with this question? What is the best outcome on July 9th? Extend and pretend or 10% and move on? Extend and pretend or 10% and move on? What's the best outcome?
I mean, if the move on was for sure, then you'd want the 10% and move on, right? But you could get 10% and move on, except we're going to come back to it in a couple of weeks. And I think that would be the bigger risk. I think what markets are probably girded up for at this point is, 70 to 80% of these countries, either a framework is in place, negotiations are progressing well, we're going to push it out. These other two are, those are the bad apples. We'll have to deal with those later. So in that sense, I think the more likely outcome is that if you could tell us for sure 10% across the board, 30 to 40% on China, and we're done, that is the best outcome, but I think it's probably the less likely of the two.
It's a small detail buried in the headlines of Q2, but if you go back to April 2nd, initially the market thought it was 10% and done, and we started to rally. And then the table got held up in the Rose Garden, you remember, with all the big numbers? You were there. All these massive numbers in this market went south.
The initial story, I believe in the Wall Street Journal, everything 10% and it's fine. And then people started saying, that's not 10%, that's 30-something%.
Handing out the handouts, and I was like, whoa, this isn't 10%. Oh, my God, Europe, Switzerland. John goes tweet that right now.
Equities right now, futures positive, 0.5%. Up next on the programme, Angelo Zino of CFRA on NVIDIA, Danny Berger on HP. The moves through Q2, phenomenal. Equities right now positive by 0.5% on the S&P. Child's play, 10% higher on the quarter, off the lows up by 23.89%. That's the rally off the low on the S&P 500, off the low of April 8th. On the Nasdaq 100, that rally off the lows of the quarter is more than 30%. Nasdaq 100 futures this morning positive by 0.65. With 2 hours until the opening bell, let's get you some morning moves and cross over to Danny Berger. Hey, Danny.
Hey, John, a little bit of deal news for you. HPE has been pursuing this takeover of Juniper Network. It had faced a lawsuit by the DOJ. As of the close on Friday, they have settled that lawsuit, clearing the way for this takeover to happen. HPE just needs to sell off a few of its assets. So those shares for HP up 10.5%. Juniper Networks, those shares up 8.4%. Also, some breaking news in the last hour. Moderna is successfully seeing one of its trials for an mRNA flu vaccine. That means that would be able to offer a combo vaccine of both COVID and flu. Now, because the uptake of COVID vaccines has been less in recent years than flu, it also means that they would, in general, sell more COVID vaccines. So those shares of Moderna up 5.4%. Finally, rounding things off this morning with just some of the banks, some outperformance this morning. Wells, Goldman, Bank of America up as much as 2.8% in the case of Goldman Sachs. No surprise, but they passed their stress test. We learned that Friday after the close. In general, the thought is that helps pave the way for more dividends, more buybacks. So the banks rallying this morning, John.
Danny, thank you. More on the banks at about 45 minutes' time. More from Danny as well in the next hour. On our radar this morning, Senate Majority Leader John Thune is rushing to meet President Trump's July 4th deadline to pass the tax and spending bill. Thune will have to appease 8 GOP holdouts who still have concerns.
The numbers are tight. He basically already lost 2 senators. When you look at Senator Tillis and you look at Ron Paul, J.D. Vance is going to have to come in, at least for his support. So he can only lose 1 more. And he's dealing with different groups of factions. We've been talking about this since the onset of the bill. It's a problem in the House. Now it's a problem in the Senate. Say you decide that you're going to be a little bit more friendlier when it comes to, say, the Renewable Caucus or those that care about Medicaid benefits. Well, what's going to happen to those fiscal hawks that are saying we are spending too much? And even if the Senate is able to do this, then the House has to deal with it. And there are going to be some problems with the House. Just take a look at Chip Roy's Twitter handle throughout the entire weekend, and you can see the Freedom Caucus is not happy what's going on the upper chamber.
You asked earlier, is it theater or is it actually a fissure in the Republican Party? And I don't know that there is such a distinction between the two because each person wants to get something. You talked about 8 members of Senate. Well, half of them want more cuts to Medicaid, and half of them want fewer cuts to Medicaid. Everybody wants some sort of reconciliation to their personal need. You just have to wonder whether markets are fully appreciating what's going to end up being in here and what kind of offsets are going to be there. This ultimately will be the debate once the market gets its hands on it.
Well, Tillis isn't running again.
Exactly.
Good morning, Mr. Senator, because I know you watch the programme. He's not running again, and he might burn the whole place down on the way out.
So basically, now that he has been freed almost of saying, I am not running again, he is giving some fiery speeches, and this could be just the beginning for him. And potentially, and the Wall Street Journal editorial board talks about this morning, potentially what Trump did is kind of broke up the Senate in this way and opened up a seat very early on for the Democrats to really start looking at when it comes to North Carolina.
Let's talk about the substance and another unhappy person, Elon Musk, the Tesla CEO and ex-First Buddy, slamming the Senate's version of Trump's bill, saying cuts to EV and other clean energy credits are, quote, incredibly destructive. Musk saying the bill will destroy millions of jobs.
And this comes for a personal reason, obviously. His company is one of the beneficiaries of some of these tax credits. It also points to another fissure among Republicans. Tom Tillis, you mentioned him before. He also would like to see some of these green energy tax cuts or tax subsidies put in there simply because they have actually bolstered some of the red states in terms of manufacturing and in terms of production.
Elon Musk is not the only one. You have a bunch of unions coming out representing construction workers. One saying last night this is equivalent of terminating more than 1,000 Keystone XL pipeline projects. You have the U.S. Chamber of Commerce coming out and saying this is a strong pro-growth bill, but there's always a but. Taxing energy production is never good policy, whether oil and gas or in this case renewables. Electricity demand is set to be enormous growth, and this tax will increase prices. It should be removed. What I'm confused about is how the administration is saying we're going to go after renewables and tax this excise excise tax, etc. At the same time, we are waiting for Trump to sign an executive order to talk about the insatiable energy that is going to be needed for AI demand. So how do you really claim you're for both? It's very confusing.
Some of the pushback there for the tax bill on monetary policy, we have had even more pushback than that, particularly from the president. President Trump saying he has 3 names in mind for his Fed chair pick. Trump was asked specifically about the former Fed governor Kevin Walsh, but said the following. He said, quote, "I don't know that it's going to be him, but he wouldn't be doing what Powell is doing."
Well, Kevin Walsh is the person who everyone points to as saying, really? He's not exactly dovish. Why would you want him in it? This just goes to build on the idea of what the timeline would be to put in a potential candidate to be the next Fed chair who could act as a shadow Fed chair. Scott Bessent on Friday was talking about this, and he said there are 2 Fed seats that come up next year. You've got in January Adriana Kugler, and then you have later on in May, you have Fed Chair Jay Powell. Ostensibly in January, President Trump could put somebody in Adriana Kugler's seat who would then serve as Fed chair when Jay Powell would end his term in May, which means that it could be the October or November or even September timeframe.
The shadow chair might be on the inside.
Exactly, which is sort of interesting.
Fun and games.
Exactly.
And lots of dissent.
Also, we need to know, though, is Jay Powell going to keep his seat?
Right.
He will not be chairman, but he can stay on the board, and he might just want to lurk.
We'll hear from the Treasury Secretary later on this morning about lurking on the FOMC and what he thinks of that. I think the Treasury Secretary's basically acknowledged that the Fed chair could sit there and keep his governor's seat.
Yeah, and that ultimately go for it. I think it ends in 2028. I believe so, and it would be. He hasn't confirmed though whether he wants to do that. I guess we'll have to see. He says his head is squarely focused on what's in front of him.
Of course, Secretary Bessent, 9:40 Eastern Time on Bloomberg TV. Look out for a conversation on that and a whole lot more. Let's turn back to tech. Chip stocks up nearly 30% in the second quarter, led by Broadcom, ARM, and Microchip Technology. The rally set to continue. Nvidia surpassing Microsoft on its way to a fresh $4 trillion market cap. Joining us now is Mandeep Singh of Bloomberg Intelligence. Mandeep, good morning.
Morning.
DeepSeek, it's all over. It's terrible. Everything's going to blow up. And here we are several months later. What changed?
Well, what changed is there are new use cases that have emerged, and coding assistant is a great example of a market that wasn't there, especially, to the extent that companies like Cursor and now Google launching their own coding assistant. That market could be $50 billion plus. That market is all driven by generative AI. So people talk about search getting disrupted. There are other pockets within software that are getting disrupted by generative AI, and that's why that reasoning aspect of what generative AI is doing with regards to your LLM being able to run any sort of browser session, any sort of code at runtime. That's huge, and that's what's driving the compute right now.
This is important, and it's fundamental, and it comes at a time where we're talking about new record highs for the S&P on the heels of the likes of NVIDIA and Microsoft, up 45% and 32% respectively, just in the past quarter. I'm just wondering, from your perspective, whether this wasn't known and whether this is a new development enough to generate the same kind of return on investment, the same kind of cash flow that would justify this type of revaluation.
Yeah, I mean, what people underestimated was that there is ROI in terms of the compute being spent. And right now you are starting to see that ROI. The other is competition for the likes of NVIDIA was the hyperscalers, your Microsoft, your Meta. Well, guess what? Their chip efforts have taken back in terms of, their ability to make a chip that's comparable to NVIDIA. And that's why a company like NVIDIA and Broadcom are getting bid up, because the hyperscaler chip efforts are just not materializing the way everyone expected.
The rally off the low for NVIDIA, 67% off the lows of early April.
You can't bet against this trend, and that's what people keep learning. And it's so hard for people who want to be bearish and say, oh, it's a bubble, but it's not. Because guess what? They just came out with this new thing. And it just really underscores there are going to be winners and losers from the AI trend. But you can't write off some of the winners just yet. And that, I think, is what we've seen.
To build on the conversation, Angelo Zino of CFRA joins us now for more. Angelo, welcome to the program, sir. Why do you leave Q2 with more confidence for this name and not less?
Yeah, so thanks for having me. I think a lot of it has to do with, what Mandeep just said, but you kind of go through Q1 earnings season. A lot of these companies, obviously reiterated their CapEx spending plans, right? You kind of go through here over the last couple of months, we've gotten some really great data points in terms of these reasoning models just kind of starting to gain momentum. I think Alphabet just last month at their developers conference kind of talked about how much more compute we're using with these more advanced reasoning models. I think, April a year ago, monthly tokens processed was about 9.7 trillion. It's up about 50-fold a year later on a monthly run rate. So we're getting a lot more compute being leveraged here. And that's kind of driving significant demand, not only from these hyperscalers, but we're now actually seeing real use cases or real signs that the spending is really broadening out, right? Not only from these big four, but we're talking about the CoreWeaves. The Oracle just had an unbelievable earnings season where they were essentially projecting a doubling in terms of their bookings over the next year. So we're seeing some real kind of momentum here on the compute side of things, and that is going to continue to drive the demand for NVIDIA, as well as other AI-oriented chip names.
Angelo, if we just totally moved on from DeepSeek, is that now not a story, or is that still something, to use Anne-Marie's word, lurking out there to really potentially threaten some of this spend?
I think, in many respects, DeepSeek has almost become a stimulant for, a lot of these AI semi-names, in the sense that it's creating kind of, a lot more of these kind of smaller language models kind of, essentially kind of leveraging off of these larger models. And you're finding a lot more use cases and applications for these smaller language models. So that's, in many respects, driving more and more demand out there and use cases for these AI agents and more compute demand. So in some cases, in some odd way, we're actually seeing significantly higher demand in a post-DeepSeek environment. Whether or not, it's come and gone and we're not going to get these efficiencies, I think remains to be seen. I think the demand for compute is just so strong at this point in time because of these greater inference use cases that I think we're going to look past this DeepSeek moment, years down the road.
Angelo, what happens when we get the sectoral tariffs looking at semiconductors?
I think that's a great question. I think that's kind of the big fear out there. I think if there's a bear case, that's what it is. The more these stocks kind of go up, the greater the risk of a pullback. Once we see, and we do expect some sort of permanent tax. And our view right now is about a 25% tariff. Once this kind of gets enacted, we'll see, when this happens, to what extent it happens. But there's really two areas or pockets of the hardware supply chain that we're looking closely at. The first is the AI server environment, right? I think every percentage increase in tariffs leads to about a 0.6% increase in terms of the cost of an AI server. And the other aspect is what the impact is going to be for the Apple supply chain and what Apple does on that side of things, how they, whether or not they pressure some of their, suppliers out there, because that's going to have an impact as well. So, I think right now the street's almost kind of dismissing the 232 semiconductor investigation. Remains to be seen exactly how all this plays out. But in the same respect, right, a lot of these companies are generating essentially zeroing out revenue in China, which could potentially come back for some of these companies. So there are going to be a lot of moving parts here. But right now, maybe to your point, there is a risk out there, and that is tied to the tariffs.
To put this all together, Angelo, is there a new reality when it comes to the Magnificent Seven that looks less cohesive than it did, say, 2 years ago, where some of the Magnificent Seven names don't seem like they are on this freight train upward in the same kind of way? I'm thinking, for example, of consumer and tariff-exposed companies like Apple, like Tesla.
That's a great question. And I think right now the street is trying to figure it out. I think maybe to your point, Apple is definitely being left behind. And, partly at their own fault, right? They've essentially fallen behind on the AI side of things. They promised the street something about a year ago in terms of the Siri integration across the App Store. They haven't been able to deliver, right? And they realize that. We do think they are going to be able to figure this out. We do think Apple's going to be more of a 2026 story. But again, if this ends up taking longer than some investors out there anticipate, like us, this is a company that could potentially be left behind for a little while. Tesla, again, name that I personally don't cover, but again, I think the street is trying to sniff some of this stuff out. And right now, it does look like the winners and the easy stories are NVIDIA, Microsoft, and Meta among the Mag 7.
Angelo, thanks for your input this morning. Appreciate it. Angelo Zino there of CFRA on tech. Just a final note there on Apple. You'll see all these vicious snapbacks, just V-shaped recoveries on the charts of many tech names. You don't see that in the same way for Apple.
There's a secular decline in terms of the refresh cycle for iPhones, but then you also have some of the questions of just AI adoption, whether they're going quickly enough at the same time of their China business and manufacturing. It's a lot of hair on a name at the same time that you got a lot less hair on some of these other names.
Stock is down 20% so far year to date for Apple. Shocking stuff, down 20%, down 19.7 to be precise. That's the latest on tech. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. The Senate is poised to approve a provision as part of the tax and spending bill preventing some states from regulating AI for the next 5 years. According to Republicans, states would be barred from regulating AI if they want access to $500 million in new federal funding for a broadband program. Meanwhile, starting today, Costco's executive members can now shop earlier than other members. The wholesale club announcing it will start opening at 9 a.m. for its top-tier shoppers. For all other members, clubs will be open at 10 a.m. weekdays and Sundays and 9:30 a.m. on Saturdays. The new schedule mirrors one long offered by its rival, Sam's Club. And Apple's F1, the movie, topped the weekend box office. The film, starring Brad Pitt, took in $55.6 million in U.S. and Canadian theaters. F1, which cost over $200 million to make, is seen as a test of Apple's strategy to release its films in theaters before they appear on the Apple TV Plus streaming service. That's your Bloomberg Brief. John?
Yahara, thank you.
John saw.
You know,
I've got some thoughts.
Okay, you don't like it. You think it's just not...
I think it's good for the sport. Just elements of that movie kind of annoyed me, and it's the audio. It's a very specific thing. Whenever they were racing, they were using like the kind of noise you'd hear if you were at the stadium or at the racetrack and you were hearing the commentary over a speaker. Instead of hearing the commentary over, say, just your natural TV audio. And it just seemed to really bug me. And it went on for 3 hours.
Can I make a recommendation?
Sure.
Instead of movies, TV series. They're really good. Streaming series.
I watch TV series as well.
Okay, well,
I'm not allowed to go to the movies.
You're allowed to go to the movies, but I'm just saying that streaming series are the new movies, in my opinion.
Stick is not a movie, but it's a great series. You watch Stick?
I haven't watched it.
Apple TV.
Department Q. Have you watched that?
Haven't watched that.
Really
no.
good.
You guys have too much time in your
I'll
hands.
do Stick, you do that, and then we'll swap.
We'll compare.
All right, compare notes. Up next on the programme, the President's tax bill facing pushback.
Can you identify anything that you could actually cut out so that you could have Ron Johnson and the other senators who are upset about the price feel better about it?
We're cutting 1.7, let's see, we're cutting, 1.7 trillion. We can grow our country so much more than that.
That conversation up next with Kurt Reiman of UBS, live from New York City. You're watching Bloomberg TV. Equity futures positive this morning, up again after a two-day winning streak through Friday and after closing on Friday at record highs on the S&P for the first time going back to February. Up another 0.7 on the Nasdaq. On the Russell, the small caps up nicely too, and by 0.55. Under surveillance this morning, the President's tax bill facing some pushback.
Problem is if we're 2 days late or 5 days late, everybody says, oh, he had a tremendous value. Whatever it is, as long as we have it. It's very important.
Can you identify anything that you could actually cut out so that you could have Ron Johnson and the other senators who are upset about the price feel better about it?
We're cutting 1.7, let's see, we're cutting, 1.7 trillion. We can grow our country so much more than that.
It's the latest this morning. A new estimate from the Congressional Budget Office saying the Senate's bill, now stuck in limbo, would add nearly $3.3 trillion to U.S. deficits over a decade. Joining us now to discuss is Kurt Reiman of UBS. Kurt, good morning.
Good morning.
Good to see you, sir. Some pushback from Republican senators and some journalists. Very little pushback from this bond market. What gives?
Yeah, pushback has been the story all throughout. When we thought about this second administration for President Trump, all the way back to even November, one of the things that we pointed out was that you can be assured of was that under united government, which is what we have, is you're going to see higher deficits over the next several years. That's come through. But the pushback has also been pretty consistent at every stage, whether it was getting this bill through the House or getting it through the Senate, which is still, we're waiting for that. We're going to hear this sort of constant, pushback, but yet the bill is likely to advance because it does a few things. It gets the debt limit solved, at least for another couple of years, and it lifts, or at least keeps the tax rates where they are. For most Americans. And I think that's an important piece, but it does do a couple of other things, which is it takes the deficits and makes them sustained at a high level for a fairly long period of time. And even the tariff income isn't coming necessarily fully to the rescue.
So, hold on a second. Sorry to cut in here, but to John's point, why isn't the bond market pushing back in the form of higher yields?
Yeah, I mean, this could happen. And I think this is something that we have to think about. Lately, over the the past couple of months, the bond market's been doing very well. We've been living through these periodic episodes where the 10-year note yield moves up to 4 3/4, or maybe even could push closer to 5%. We've been concerned about that. At 4 1/4 on the 10-year, this is about as good as it gets in our view.
So you think this is the floor, and that the yields are going to go higher from here?
They could, over the course of the year, if growth slows, as we expect as a result of the tariffs, yields could move a bit lower. But our view is that it's going to be higher first. And from that point of view, it's sort of like a seesaw. You think about the way that the bond market's been moving. Our view is that over the course of this year, we get Fed rate cuts, and that should be beneficial. But then there are other concerns about the tariffs leading to higher inflation or deficit concerns, or maybe even geopolitical risks if oil prices were to, again, move higher. All of these factors are keeping us from moving out the yield curve and taking on additional interest rate risk. And let's face it, why do we have to? We're not forced to. If you can get 90% of the 10-year yield in a 5-year, then take that, and that should be sufficient. So hug the intermediate part of the curve, and at around 4%, that's a good result.
But to Lisa's point, if we are right now in terms of a floor in the 10-year yield, how high are you talking about it can go? What's the ceiling?
I would be looking for a range between 4 1/4, 4 3/4 over the course of this year.
5%?
I wouldn't rule it out. I would not rule it out. The bond market is going to be taking cues from a lot of different forces over the course of the next several months. And it's this back end that we're seeing with rates having now compressed that does look susceptible. So again, we're keeping in the belly of the curve, and that to us is providing decent value.
This sounds like a period that we saw play out last year, where the Fed could be reducing interest rates, but mortgage rates go up. Are we going to see a repeat?
I think that's what we have to be careful of. I don't think there's going to be any Fed chair that over the next 4 years that's going to get a free pass on policy. There's going to be, again, you think about pushback that senators and members of the House have against the bill. The president is going to keep the pressure on the Fed chair no matter what. I think coming into the back end of this year, though, he'll start to get some of the policies that he's hoping for. But, it's in a form of a 1/4 point cut and gradually. So over the course of the next year, we might see rates another full percentage point lower. But the Fed has to be careful. And I think when you're administration, you also have to be careful that when you move rates lower, you also have to be cognizant of the possibility that long end rates go higher and mortgage rates go higher. And these are also concerns of the administration. You'll have Treasury Secretary Besson on later. I think this is a great question to ask him.
Yep, at 9:40 Eastern Time. Kurt, appreciate the promo and your appearance. Thank you, sir. Kurt Reiman there of UBS. This was the nightmare of last year. Down 100 basis points at the front end. Yields climbed at the long end.
And this could potentially be the cautionary tale for why the Fed doesn't want to cut rates too aggressively later this year.
Bond market pretty well behaved at the moment, at least. Up next on the programme, Eric Freedman of US Bank Asset Management, David George of Baird will catch up with the former Kansas City Fed President Esther George and Michael Kushma of Morgan Stanley. The third hour of Bloomberg Surveillance just around the corner.
When we've had big movements in trade deals, that it does create a lot of volatility, it does create a lot of noise.
Quite quickly, we're looking to come to agreements.
We're expecting an average effective tariff rate of around 14 to 15% by year end.
I don't think these tariff deals are going to be done that quickly. I do think the tariff uncertainty will continue.
We're all looking at sort of the black box right now, waiting as this information comes out.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now with equity futures positive once again, up by 0.4% off the back of a two-day winning streak on the S&P 500 and another all-time high at the close just last week. This morning we had some weight to the rally, up nicely on the S&P and on the Nasdaq, and on the quarter up 10% for Q2 on the S&P 500. If you looked at that, there's nothing to worry about. If you looked at this, there might be something to worry about. In the FX market, euro dollar on an 8-day run, 117.25, an 8-day run of dollar weakness. And on the quarter, a move of 8% for the single currency. That is a lot of dollar weakness.
We've been asking, where are the bond vigilantes? Why aren't yields higher as we look at this one big, beautiful bill and a potential almost $4 trillion addition to the deficit? We were just talking to Kurt Reiman. He said maybe the vigilantes have moved. Maybe they moved from the bond market to the currency market, and they're selling the dollar. And that is the way you're going to see an expression of concern around the fiscal outlook for the United States, as well as a host of other issues. Whether this is coming from outright selling or whether this is hedging, a lot of people will be discussing, but this really is the takeaway, the big change over the past 3 months.
The pressure valve for all the tension over the last quarter or so. Going into the next week, as we start to think about July, we are hitting the ground running. We've got payrolls Thursday, a self-imposed deadline for taxes on Friday, and then into next week, another self-imposed deadline for tariffs and trade.
The operative term to this deadline is self-imposed, which makes you think potentially they can slip and it won't be the biggest deal in the world for the Republican Party. Right now, the Senate is dealing with this, and in hours' time, they're going to start this vote-a-rama. This can go on for hours. We are talking about the early hours of the morning. Potentially, we can see this continue. Even if Senator Majority Leader John Thune is able to get the ducks in a row, he can only lose 3 votes right now, and he pretty much has already lost 2 senators, and he has a number of different factions he's dealing with. Then the House has to deal with this. And the CBO scoring comes out and says the tax and spending measure would add nearly $3.3 trillion to U.S. deficits. If you look at the Freedom Caucus Twitter handle over the weekend, they are not prepared to vote for this bill.
We've already given a history of the vote-a-rama and of exactly why this word is
Do it again,
framed.
Grandma.
Because it is a vote-a-rama. You get an amendment. You get an amendment.
It was, well, it's just going to be this long thing, but the word vote-a-rama was fashioned as early as 1992, and then it developed into 1996, where it was really codified by a Republican senator. I think it's getting a little dated. It sounds like it was from the 1980s. I'm going to propose Votapalooza.
Nice. Is that going to be the change?
Yeah, from Vote-a-Rama to Votapalooza, because I think that that's a more modern take.
You should write a letter to the Senate Majority Leader.
I'm sure that you will take that up right
Senator
away.
Thune will make that
They could
fashionable
debate
for
that
you.
particular.
That's the value add so far this morning. If you're looking for anything else, got nothing for you. Coming up this hour, Eric Freedman of US Bank Asset Management with stocks back at all-time highs. David George of Baird after downgrading JP Morgan to a rare sell rating. Look out for that later. And the former Kansas City Fed President Esther George saying it's too soon to call for a rate cut. We begin this hour with stocks rising after the S&P 500 posted its first record high since February. Eric Freedman of US Bank Asset Management writing, in this environment, we want to be either overweight or neutral risk. The time for being cautious is behind us. Eric joins us now for more. Eric, welcome to the programme, sir. If the time for being cautious is behind us, how confident are you that bad data isn't still in front of us?
We think there's probably a bit of a back and forth, Jonathan, on the data front. You know, the employment market, your team has done a great job of covering it, is probably, at least in our estimation, the shakiest parts of the current setup, meaning there's a lot of underemployment. We think that businesses writ large are still very cautious in terms of making what we're going to call more exploratory CapEx decisions. Most of the CapEx decisions we see from companies is really more maintenance in nature. So I think in this environment, what may go wrong is a softening, weakening labor picture. Certainly we could have trade talks that go the wrong way, but in general, we think that momentum is still positive. And again, we would be on the side of being either neutral or overweight risk assets here.
That's certainly the risk going into something like payrolls Thursday. The median estimate so far for people just tuning in, 113 at the moment. The previous number for the month of May was 139. Eric, you keep saying overweight or neutral. Can you pick one for us and just explain how you've used this recent bout of strength over the past few months?
Yeah, we've really been using it, Jonathan, as an opportunity to lighten up, get back towards more of a neutral positioning. I think, if anything, momentum probably continues. So what we be doing for clients is if they're normally, let's call it a 60% equity investor, if they want to add another 5-10%, we just hedge it. And I think that one of the things that we're really paying attention to, and again, you've done a nice job covering it this morning with currencies, is looking at correlations. One of the things that we always think about is, of course, what are stocks and bonds doing together? The reality is that stocks and bonds have actually been moving in the same direction, which for us is not a good thing. So what we think is the most prudent thing to do for investors is to still have that glass half full viewpoint, but actually use more outright hedges as opposed to being, more reliant on traditional asset allocation to do its thing. So we think, again, using some opportunities to feed the ducks, as a technical phrase in the industry, and certainly bank some gains concurrently. We think the time to be overly cautious, as I said earlier, is certainly a response to maybe a deterioration in the labor market, or if trade talks go the wrong way, which we don't think they ultimately will.
So you're renting pessimism and holding on to optimism. Is that a good way of putting it?
It is, Lisa. I think that's in sort of a rent-controlled world, if you will. Our viewpoint is that, this is an interesting time of transition on the policy front. You certainly hear a lot about the Fed, but we do think this is going to really boil down to what companies do with budgets. And one of the things we're really using as a gauge as we head into earnings season is just how confident and how thorough is forward guidance. That's something that actually has been a real lack, if you will, in terms of the bottom-up analysis that we do, is just how skittish companies are about being definitive with their plans. So we do think that with the passage of the bill, which again, we'll see if that July 4th deadline sticks, but let's call it by mid-July, late July, that will give opportunities, we think, for companies to think about employment plans. And again, we think the bias is still for reinvestment in companies. Certainly share buybacks will likely continue, but those are two things that still give us some optimism for the path ahead.
Do you see certain stocks that are better to be pessimistic on than others? I mean, one major theme of the past month or 3 months really has been NVIDIA and Microsoft skyrocketing everyone else upward, and the actual leadership has been relatively narrow. We're starting to see it broaden out with this hope that we will get maybe better than expected data, or if we don't, that the Fed's going to cut rates. Where are you most pessimistic? Is it on the big tech names and valuations, or is it just the economic deterioration that you do expect possibly to come to the fore with respect to the labor market or other indicators?
Yeah, to your point, Lisa, it's been a very nuanced move in terms of leadership in equities. And the part that we'd be most concerned about would be those retailers that are really focused on, let's call it, middle income consumers. That's the vulnerable set, we think. If we see companies continue to delay employment in terms of wage growth, you did a nice job covering that earlier this morning. But then also, if we see, credit just continue to, let's call it, weaken at the margin. We don't think there's going to be a massive credit shock, if you will, but we are seeing delinquencies pick up, not just in areas like auto loans. That's been certainly the case for some time, but certainly the midpoint of credit, as well as what we're seeing in the CMBS markets or real estate, continues to show some weakness as well. So where we'd be most concerned would be those retailers that are really focused on middle income earners. That's probably the swing factor for us. We like discount retailers. We like some of the more luxury brands, if you will, on valuation. Those are spots that we like, but that middle income consumer we think may be a bit vulnerable here.
Well, you rate the consumer as 5 out of 10. How do you get to that rating? And do you think in the future it's going to move up, or do we have a chance to potentially see the consumer drop?
Yeah, Annmarie, it's a great point. So, we look at, as you mentioned, consumers. We score them between a 0 being weakest, 10 being strongest. And right now they've gone from about a 7-8 in 2022 down to a 5 presently. And so we think there will be some stability with likely an upturn, particularly for, we think, lower income consumers as well as for higher income consumers. What we don't have enough data on yet in terms of having a really strong convicted view is what happens to middle income consumers. That we think will be a function of what happens with house prices. Also, as I mentioned earlier, the quality of the employment gains. That we think is an area that is still to be determined. But there's lots of things to do while we wait for more clarity. So we do think there will likely be some stability with an upturn, not necessarily so rate sensitive, but really a function of the CapEx cycle doesn't return. We think it ultimately will, and we think that betting against that, if you will, is not what we'll be doing with client money right now.
I know you're glass half full in terms of client portfolios, but you sound a little glass half empty when it comes to the consumer.
Yeah, I think that, if you look at the different components of the consumer spectrum, Annmarie, I think in general, the industry doesn't do a great job of bifurcating out just the sub-cohorts. So we're actually very, very positive on higher income consumers. We think that lower income consumers have actually withstood a lot of body blows of late. What we're still, again, we are glass half full with middle income consumers, but we're still concerned about how that may swing in the event that there is a delay, if you will, in that CapEx cycle, or if there's a delay in tariff reconciliation. So that's the part that, again, there's lots of things to do while we wait, but I still think in general the upturn is there on the consumer side writ large. There's just a lot of variation within the sub-context of consumers as one big cohort.
Eric, it's been too long. It's good to hear from you once again. Let's do it again soon. Eric Freedman there of US Bank Asset Management. You said it so many times this quarter. The market is not the economy. The market is not the economy.
And ultimately, you see a number of companies that are benefiting from technological changes that are really underscoring how much that's the case. It sounds like he's a quarter glass full when it comes to the lower income cohort. He's 3/4 half full when it comes to the higher income, and then he's feeding the ducks in the middle.
We should acknowledge, though, there is still some tension here. He thinks that the time for being cautious is behind us. Certainly been conditioned and reinforced by what we've seen in the market. But ultimately, you have to be wary that the worst of the data might be in front of us. And that's the issue I think a lot of people have got, including Stuart Kaiser of Citi. Citi are looking for some terrible numbers on Thursday. And from a tactical perspective, he was making the point that's not something he's comfortable being long into.
This is the reason why derivatives traders right now are going to have a really interesting time. And I'm looking at that kind of revenue coming out of the banks, because ultimately nobody wants to be wholesale committed to any particular trade. They want to do it in a renting it type of way rather than buying or selling it wholesale. They don't want to commit at a time where they just don't know, and probably we're going to muddle through and we'll be in the exact same place in just 3 months' time.
Love your framing. Rent the pessimism and own the optimism, or just embody the pessimism?
Embody the pessimism,
okay.
But, buy the optimism, because, you need to actually live.
And make some money. Yeah. Equity futures right now in the S&P positive by 0.4%. That was all too honest. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. Senate Majority Leader John Thune is rushing to meet President Trump's July 4th deadline to pass his massive tax and spending bill. But Thune is facing opposition from 8 Republican senators and must find a compromise. Some are pushing for deeper spending cuts, while others want more funding for health benefits and renewable energy subsidies. Meanwhile, Canada is making a move to try to jumpstart trade talks with the U.S. It's withdrawing its digital services tax on technology companies, including Meta Platforms and Alphabet. This comes after President Donald Trump said on Friday he was ending all trade talks with Canada in retaliation for that digital tax. And in sports, the Yankees took 2 of 3 from the Athletics over the weekend, winning Sunday's game 12-5. With Aaron Judge hitting 2 home runs, they now hold a 1.5-game lead in the division over Tampa Bay. The Yankees are looking ahead to a Subway Series starting Friday with the Mets, who've won just 3 of their last 16 games. Sorry, Lisa. That's your Bloomberg Brief. John?
Yahira, thank you. Did you put that in there?
I did, because I was at the game, and
Judge, did you pay her to frame it that way?
I didn't write the script. I just said we should really put the Yankee game in there, because I was there yesterday. Judge's 2 home runs were amazing, and there's an amazing stat to this. 44th career multi-home run game was yesterday. He is now sitting 3rd for this achievement behind Babe Ruth and Mickey Mantle. It's pretty incredible.
And the Mets?
Mets are Mets.
The season is young. Things could happen. And, it's been a bad streak. We can recover. Honestly, how much, I'm going to buy cookies for everybody.
That script's pretty brutal.
Okay.
That was pretty brutal.
That was really, as they head into the Subway Series with the Mets flat on their back.
Every time I travel, I will say this. I do bring the team back goods from wherever I am.
So you bribe them. All right. Up next on the programme, the Morning Calls plus David George of Baird after downgrading JP Morgan on valuation concerns. That stock is up almost 20% for 2025. That conversation up next, live from New York City this morning. This is Bloomberg. The up and about 1 hour and 13 minutes away. Equity futures rallying going into it, up 0.4% on the S&P, up by 0.6 on the Nasdaq 100. That's some of the price action. Let's get you a few of the morning calls. Here's three. The first one from Stifel, upgrading Oracle to buy, seeing sustainable acceleration in the company's cloud business. That stock is up by more than 2%. Your second call from Guggenheim, raising its price target on ARM to 187, citing higher revenue growth despite weak corporate IT demand. That name is up by 0.9%. And your third and final call from Jefferies, upgrading Disney to buy, seeing more park upside in the second half of the year. The stock is up by more than 1% in the pre-market. Let's turn to the big banks. Optimism over the outlook for the sector driving JP Morgan to fresh record highs last week, but not everyone is buying into the rally. David George of Baird downgrading the company to a rare underperform rating, writing, "We realize we are fighting the tape here. We simply think that expectations are super high." David joins us now for more. David, thanks for making time for us this morning. This isn't something you see too often from the street or from you personally. So let's start from the top. Why the downgrade?
Good morning, John. Yeah, it's very simple. JP Morgan, and I think it's important for viewers and you all to understand and appreciate the fact that in addition to following companies, we also follow stocks. And the stocks, as you were saying in your last segment, the market is not the economy, and stocks are not always companies. And from our perspective, the risk around some of the big bank names has gotten a little more elevated given the big moves. As you mentioned, JP Morgan, we're urging clients to sell stock here, given the fact that the shares are at the record valuation, trades at close to 3 times tangible book value, almost 10 times pre-provision earnings. They typically trade at just 10 times earnings. Forget about pre-provision earnings. And we're simply of the view that returns in this stock from here are simply not going to be as good as they've been in the past. And the risk in stocks in general, but banks in particular, particularly the big ones, are a little higher today than they were in April when they're probably 20 to 25% lower.
David, is your big thesis just simply a valuation thing and that the bank sector is not necessarily going to be the growth engine that it was, say, 20 years ago with all of the deregulation and what have you that's going to be coming from Washington, D.C.?
Well, I don't think, Lisa, that banks are a growth sector, and that's okay. From my standpoint, we think about banks as a risk-reward sector. And this is a group that's going to grow pre-provision earnings at around 6%, 6 to 8% per year. You're going to get a little bit of capital management in the form of dividends and buybacks, and that's going to be a pretty respectable return in a high single to low double-digit area. What's important, given the fact that this is a relatively low-growth sector, is the price that you pay. And returns, we think, are very highly correlated to the price that you pay. And from our perspective, but buying the stock here just doesn't make a whole lot of sense to us, given what you're paying for it here.
I framed it like that, David, because there is a thesis out there that banks have not been a growth sector for the past 20 years, in particular on the heels of Dodd-Frank and as an increasing amount of business went to private asset managers. There is a theory out there that some of the deregulation and the changes are going to allow the biggest banks to compete more aggressively with private asset managers and potentially take more risk, also get bigger returns to make them a growth sector once again. Do you think that there is any validity in that type of thesis?
I think there is a lot of positives around deregulation. I think this time every summer for the last 7-8 years, Lisa, we as investors and analysts we're always bracing ourselves, expecting regulators to find reasons why big banks need more capital. And today, we think we finally kind of crossed the Rubicon of being at a level where banks have adequate capital levels. And that, I think, positions the sector to be in a position to return more capital to shareholders in the form of buybacks and dividends. And I think for the biggest banks, what you'll see in addition to maybe a little more capital return is adding a little bit more dare I say, a touch more leverage to be able to accommodate trading. So we would expect trading assets to bulk up a little bit. And that really is simply a function of not to add risk per se, but just to be in a position to accommodate clients more freely. As it relates to things like private credit, that's not something that we would expect credit risk to meaningfully change. This is really more a function of more capital. And I think it's better for sentiment. I think a more friendly deregulatory environment is also conducive to bank M&A. That's something that we think is going to happen, is why we're a little more constructive on the smaller regional banks or the super regional banks. But that's kind of our view on deregulation.
But when it comes to something we actually just saw last week, when it comes to the SLR, isn't that impact going to be for the bigger banks, not the regional smaller banks?
It is. And that, again, going back to kind of my initial comments, is priced for that. JP Morgan is at 3 times tangible book, and there are several regional banks that are trading at half of that price. Now, JP Morgan's a fantastic company, but that SLR reform, among others, we think has been largely played out. And there's been a lot of buying of the rumor and we're seller of the news, Annmarie.
David, appreciate the update from you, sir. David George there of Baird with a rare downgrade for the likes of JP Morgan, just in terms of earnings and the dates you can expect to get these reports. Earnings from JP Morgan 2 weeks tomorrow, so just around the corner, July 15th. And just an update on that stock, record high on almost $800 billion market cap over at JP Morgan now.
And I think that David George's point is it's a great company. There are a lot of potential tailwinds, but the valuation has gotten to a level that's extreme given the fact that this isn't probably going to be the growth engine that it was during the heyday of the 1980s, that kind of banking boom that you could have seen under the super leveraged model that you saw at a lot of these banks. It really raises the question where the bar is going to be for some of the earnings and whether people have too much baked into some of these and too little baked into some of the smaller banks, especially with mergers and acquisitions, as well as some of the loosening when it comes to leverage requirements.
Could you pump this quarter? Stuart Kaiser of Citi was talking about that. Last quarter, you could sit there and say, we don't know what the policies are going to be. Are we going to know what the policies are going to be in 2 weeks and a day?
You know, we won't know what the policies are going to be. They will know what the pipeline looks like. And they always say the pipeline looks very robust. But we did hear at recent meetings, they aren't expecting the same kind of M&A activity and the IPO activity that they were at the outset of the year. They have ratcheted that back. We can understand that. We can understand just how much the derivatives trading has increased, particularly on the FX wings. And we can understand what the risk appetite is. And I think that will be a really key indicator. They can't just punt completely.
Well, the thing is they might be talking about what the earnings are and the outlook and uncertainty in Washington at a time when the administration is trying to announce deals. I mean, July 9th, no one thinks we're going to get these deals in place. This is going to be a story for the entire summer. So we might have a little bit of wiggle room to punt.
Do you remember being on $1 trillion watch for tech names? Do you remember that? Doesn't feel like that long ago. We're almost on $1 trillion watch for single bank names. Compare that to, say, Barclays. I think Barclays, the market cap over in the UK, is something like 50 sterling. Something like 50 billion sterling. And here we've got JP Morgan close to 800.
It's really smart that you talked about tech companies. Now we're talking about $4 trillion tech companies when it comes to NVIDIA. Because at what point do the biggest banks have an advantage technologically to really capitalize on how much efficiency they can really generate, as well as nuance when it comes to trading advice, et cetera? And you have to start looking at that type of change to really juice valuations also. Because think about if they could do the same amount of work with so many fewer employees, well, how much would that return on investment be?
Each additional dollar of revenue is going to be less and less labour intensive. It's Brian Moynihan of Bank of America that got us onto that a few years ago, wasn't it?
Yeah, and there's
just dead on.
Yeah, and there's a feeling it's not going to lead to layoffs right now, but it's not going to lead to hiring, and you're certainly seeing that with college graduates.
Big time. It's a big week for jobs data. Payrolls is just around the corner. Up next on the programme, the former Kansas City Fed President Esther George saying it's too soon to call for a rate cut. Plus, Danny Berger with your morning movers and a deal in the home improvement space. That's next. This is Bloomberg. Wrapping up the first half of 2025. 1 day away. Almost there. Q2 felt like a year. Never mind a quarter. Equity futures at the moment positive by 0.4% on the Nasdaq 100, up by 0.6. With your single names this morning, your morning movers with 60 minutes From the opening bell, here's Danny Berger. Hey, Danny.
Hey, John. Kicking it off with a little bit of deal news. Announced moments ago that one of the subsidiaries of Home Depot will be buying GMS. GMS is a distributor of various building products. It's a way really for Home Depot to try to tap more into that professional contractor network. The deal values GMS at a nearly 13% premium. So you can see the pop in shares there, up about 11 1/3%. The total deal ticket about $4.3 billion. Now, elsewhere to the downside this morning, a lot of the clean energy names really getting hit in today's trade. NextEra, one of the biggest losers, down 5.8%. AES, Enphase, all of them hurt after the latest version of the One Big Beautiful Bill had a quicker phase out of tax credits for clean energy products. That will phase out in 2017. The expectation was it would take longer for that. It also included a quicker phase out in September of EV credits, of EV tax breaks for purchasers. So that hurting Tesla shares. It's off some of the lows of this morning, but down nearly 1%. Elon Musk also taking 2x to slam the One Big Beautiful Bill. John?
Danny, appreciated that pushback coming from Elon Musk, coming from Republican senators. And as we've repeated throughout this morning, it's not coming from an important place. It's not coming from the bond market over the last month.
We haven't really seen yields rise in tandem with the expectation of the deficit increasing in the same people as some people were arguing earlier this year. There is, however, that constant weakening in the dollar. And at some point, people are going to look to the bond vigilantes turning into FX vigilantes. And that's, I guess, what we're seeing.
Bond yields this morning down by another 2 basis points, 4.25 on a 10-year maturity. As we look ahead to a busy week of economic data, really climax with payrolls on Thursday. Payrolls Thursday, of course, before the long weekend here stateside. Mike McKee has more for us. Good morning, Mike.
Good morning, John. Well, it is going to be a very busy week. The first week of the month always is, but this month it is more crowded because we've got the holiday at the end of the week. I'm going to divide the week up into two. First, we get Monday, Tuesday, Wednesday, which have some major indicators in them. We get the ISM manufacturing and JOLTS report tomorrow and ADP jobs on Wednesday, and all of those will drive some market volatility. And then it's Thursday. That's the big day. Everybody has to come in early. June jobs, May trade, jobless claims, ISM services, and durable goods. There's going to be a lot to talk about there. Obviously, the question with jobs is, are we slowing down? And is that going to presage some sort of move in the bond market with rates falling if people are worried about the economy slowing down? We don't get a lot of Fed speak to talk about this, just a little bit. Today we have Raphael Bostic and Austin Goolsbee. Tomorrow's going to be very interesting. It is the European Central Bank's version of Jackson Hole, Sintra, and they have a single panel including Jay Powell, Christine Lagarde, Kazuo Ueda, and Andrew Bailey. Whether they will talk about their own individual banks and their plans is not clear, but there is that risk. You got to pay attention. Thursday, Raphael Bostic is back. I wouldn't ordinarily include it, but he's the only one speaking after the jobs report, so he will probably have more to say. And the interesting thing about all of this is, guys, we could see in a normal month that this kind of data would drive trading for a while. But unfortunately for the markets, the president's reciprocal tariffs come back next week, so there may be a short half-life for all this stuff.
Mike McKee, thank you, sir. Two important deadlines, of course, after payrolls. We've got taxes on July 4th, Southern Post, of course. Then July 9th, we've got the trade story. 8:32 or 8:31, the rush to the beach. When does it start? 1 minute after payrolls, 2 minutes, 5?
It depends what the number is. It depends. If it's a really low number,
you
then
do it on the
really
beach.
Significant.
You do
I thought
it.
we'd moved on from that.
You do it on the beach.
The pushback from work from home,
Yeah,
work
absolutely.
from the beach.
Or week from.
But it's a special week.
Sintra, Portugal, which looks beautiful. I love the difference between Europeans versus the U.S. In Europe, it's like, this lovely kind of cultivated experience. And in the U.S., it's go hang with the bears. It's sort of very rugged out west. It just sort of reminds me of the divide.
Which I'll be giving a miss later this summer. I think you're going, right?
I am going. I will don my bear bells.
Good.
I'm actually very curious to see the wildlife and also the
And Chairman Powell.
discussions.
And the bears. however you want to frame it.
Yeah,
All right,
exactly.
let's move on. Former Kansas City Fed President Esther George expecting the Fed to stay on hold, writing the following: although inflation is not accelerating, it remains sticky and appropriately ties the Fed's hands on further rate adjustments. Esther joins us now for more. And Esther, for someone who used to lead the Jackson Hole Symposium, I apologise for Lisa. Just ignore everything Lisa just said.
I love it.
I loved the forum and I love seeing you over there.
Okay, can I just say, I'm the one person who... No, I'm not going to apologize because I'm just going to say I love it. I love the experience. I love the land. I'm a big proponent. I'm staying longer so that I can go tour around and take hikes. But carry on.
Leisure.
Esther is convinced.
Yes, I thank you.
Esther, let's start with that quote. It's an important one. Do you believe the labour market is strong enough to wait to see what happens with inflation?
Well, we're going to find out, obviously, with this week's report, how the labor market is faring. We have seen the labor market first kind of come into better balance, if you will. The number of job openings has come down. We do hear anecdotally that businesses are hanging on to people. In some cases, we'll see whether they're shedding people, what the labor force looks like itself with all of the policy changes that have been going on there. So I think there's a lot to watch for in this particular report that could begin to give us a sense of how the labor market's doing.
You know, Esther, just to build on the Jackson Hole Symposium, this year it's talking about the changing nature of the labor market and how difficult it is to really measure it. To pair that with the number that we get on Thursday, there's this belief that it's going to be lower than many people have become accustomed to, but that still is healthy. How do we gauge a market and its health that is so in flux, both from the policy perspective and the technological perspective?
Yeah, it's especially hard, Lisa, because I think we have come off a period that was, I'm going to call it unusual, to have an unemployment rate in the neighborhood of 3.5%, and trying to diagnose what are the characteristics that are shaping that labor market is essential to how the Fed really calibrates its policies. You think about both sides of our calculation here, that we have seen the bottom line number around who's in the workforce. We have seen the hiring numbers, and trying to really assess that in a time of great uncertainty is one of the Fed's biggest challenges.
There's a big debate right now on Wall Street in the push-pull of, is this market, albeit not strong, not overly weak, just weakening, whether it's still healthy enough or whether it potentially is showing real cracks, like Neil Dutta has pointed out, of a Renaissance macro, especially given the fact that the hiring rate is so low and people are staying on the unemployment rolls for longer. Do you have a take for that? Do you think that there should be more emphasis placed in one thesis than the other?
So I don't think you can weight one or the other. We know that the dynamics in our economy today are pushing in both directions. We've seen an economy that's beginning to slow. It's being hit by policy changes that businesses are trying to digest here. And so I think you really have to not lock into a particular narrative here, but be watching how those dynamics are unfolding. Remember, today, the economy is still in forward motion. It is still operating in a way that we see growth. Obviously, that can change with any particular data point or news announcement that we see. But I think the fundamentals here suggest that we shouldn't read too much into any particular narrative at this stage.
If April 2nd hadn't happened, I'd love to explore this with you. If it hadn't happened, given the downside surprises we've had from core CPI over the last, I think, 4 months, and the uplift we've seen in continuing claims, which on the margin is slightly concerning, would you have voted for a rate cut based on that alone?
You know, Jonathan, I don't think so, and here's why. I view price stability as a prerequisite for sustained growth, for a healthy labor market in the long run, which is what the Fed's mandate really is looking to the long run. And so I think when you see fiscal policy on the path that it's been on, it would be by itself, I think, reason to be cautious right now in an environment where the Fed has not yet hit its inflation target. So I don't want to take anything away from the fact that we have made progress, but I would also want to be careful in that risk management scenario that you're not putting too much promise yet on a state of inflation that has yet to be achieved.
Speaking of risk management, if we get an announcement from the president in October, even early as September, of who the next Fed chair is going to be, who his pick is, will that blur the lines of the Fed, its independence, and who's really leading the institution?
Well, I don't think so, as long as the current Fed chair is in his seat. He's been very clear, and I think he has every incentive to be focused on policies that achieve the Fed's mandate. Does it complicate communication? Does it create a lot of noise? Of course it could. But I think any Fed chair is going to understand that their obligation to meeting their congressionally assigned mandate is really the priority. And in the end, you're doing that on behalf of the American public. You're not serving just one part of the government.
Esther, always appreciate your take on things. A clinic, as always. Esther George there, the former Kansas City Fed president, with her views on what this Fed should and shouldn't be doing right now. My takeaway from that conversation, mission is not complete.
Yeah, I thought that your question was right on. The idea of take away the tariff debate. Do you still end up at the same place in terms of a rate cut? And she said, yes, I do, simply because we are not necessarily fully at that 2% target. And that is the ultimate mandate of the Federal Reserve.
We talked about this just last week. By the time you get to September, for the big deal that we're all trying to make of the Fed chair race, and it's important, I think we'll all acknowledge that. But by the time you get to September, they might be doing what this president wants anyway. So by the time we get to September, there might be no drama involved at all.
We're completely on the same page. When people pound the table and say the Fed needs to be cutting, and you ask them, well, is September early enough? They're like, yeah, sure. And they're basically saying they're probably going to cut in September.
We can have back-to-back Truth Social posts where the president announces a new Fed chair, Jay Powell cuts, and the president is praising Jay Powell. And then there's the question of his chairmanship is up 2026, but his term as a governor is up January 2028. Does he stay on and lurk? That's what I want to know.
Depends who the pick is. Depends who the pick is, and it depends how early they announce the pick. There's a lot still to figure out. You might get some answers to some of this. You might not, but we'll ask the question anyway. Later on this morning, 9:40 Eastern Time on Bloomberg Television, we'll be sitting down here at Bloomberg TV with the Treasury Secretary, Scott Bessent. Our lead financial correspondent, Shonali Bassett, will be conducting that interview in about an hour from now. Equity futures on the S&P, positive by 1/3%, with an update on stories elsewhere. With your Bloomberg brief, here's Yahira. Hey, Yahira.
Hi, John. Nintendo has pulled its products from Amazon's U.S. site following a disagreement over unauthorized sales. That means Amazon missed out on the recent launch of the Japanese company's Switch 2. Nintendo made the move after noticing that third-party merchants were offering games for sale in the U.S. at prices that undercut its advertised rates. Meanwhile, Meta is ramping up hiring for its AI superintelligence group. The company signed on 4 notable researchers from OpenAI. Meta CEO Mark Zuckerberg made headlines this month for beginning to personally recruit AI researchers and engineers after being frustrated by his company's shortcomings in the space. And Tesla CEO Elon Musk is slamming the Senate's latest version of President Trump's tax cut bill. In a post on X, he said cuts to EV and other clean energy credits are, quote, incredibly destructive, and the bill will destroy millions of jobs. The Senate tax bill would bring a quicker end to the $7,500 consumer tax credit for EVs. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day and the week ahead. A shortened trading week, but it's a busy one. We'll get the thoughts of Michael Kushma of Morgan Stanley as well as the bond market awaits the payrolls report. Live from New York, this is Bloomberg. Up in about 43 minutes away. Equities at the moment positive by 1/3%. Likewise on the Nasdaq, a lift to this market up by 0.5. What a run it's been, and what a run this week will be as well. This week is absolutely stacked. Check out the trading diary. It looks like this. Today at 2:30 Eastern Time, President Trump signing executive orders. Tomorrow, JOLTS job openings and ISM manufacturing, plus this. Fed Chair Jay Powell and the ECB President Christine Lagarde both speaking at the ECB Forum in Sintra, Portugal. Then we get more data on Wednesday with the ADP employment report. More data on Thursday Monday with the trade balance, jobless claims, and the big one, the payrolls report for the month of June. Then on Friday, the long weekend begins, but you're probably going to have one eye on the news, maybe both. Markets might be closed, but President Trump's self-imposed deadline to pass his tax and spending bill kicks in. A lot to look forward to. Michael Kushma of Morgan Stanley believes we're currently in a sweet spot for markets. Doesn't feel like one, but we have the unemployment report, budget negotiations, tariff deadlines, all coming up over the next 2 weeks or so. Michael joins us now for more. Michael, good morning.
Good morning.
It hasn't felt like a sweet spot for markets. I guess if you're away from all this and you see the stock market at record highs, it might feel good. But if you've been in it, the last 3 months has been brutal, hasn't it?
Absolutely. I'm really talking about a sweet spot from all the worries that we had just a couple of weeks ago. All the negative things which could happen have dissipated, at least for the time being. But we've got this calendar coming up this week and next couple of weeks through July that are quite impressively, potentially volatile. But like the digital service tax with Canada yesterday, they get positive news at the margin, just dripping it back into the market to reduce the intensity of worry.
Early November, when the election happened, we were wondering whether this bond market would push back. What would be the biggest constraint on this particular bill down in Washington, D.C.? And here we are, and this bond market is not pushing back at all. Why?
I think it's the confidence that rates are going to be cut, that the deterioration in the labor market is going to continue, and that continuation of the labor market and the idea of the Fed policy being a balance between employment and inflation. But as employment drifts weaker relative to inflation, inflation's been good the last couple of months, but again, it's been good seasonally the last couple of years as well into the summer. That's why they cut rates last September. Is it going to deteriorate the next couple of months? But if inflation deteriorates, if unemployment deteriorates, I think the Fed will react to that.
It seems as though the bond market and stock market are getting excited about different things. The stock market's getting excited about AI and the potential for things to be sort of muddle along enough to allow companies to keep innovating and possible regulatory rollback. The bond market's getting excited about enough weakening that the Fed can cut, but not too much weakening that it'll fall off a cliff. Is that basically where we're at?
Exactly. Rate cuts in a still growing economy is perfect. The economy's forecasted will deteriorate, 1% growth and back to trend growth next year as the Fed cut rates. How good a combination is this?
So why are we not talking about the Fed cutting rates at a time where the economy is still moving forward, to use Esther George's phrase, with a budget that is getting more deficit driven? And those fears still here, the dollar being sold, institutional investors overseas, real questions about how much they will be the incremental buyer of treasuries. Why are we no longer talking about that whole dynamic at the long end?
We still think there's going to be a steepening bias for that reason. Think about, in terms of the back 10-year yields or longer, that we had a savings glut in the old days and a shortage of safe assets. The budget deficits were shrinking in Europe, the United States, shortage of safe assets. Now we have an explosion of safe assets. And that's going to put demand, for demand to be substandard relative to the supply of longer-term government bonds, whether it's European, whether it's U.S. or other countries. Pressures on budgets will continue, which again gets back to the point that why is the Fed going to be cutting rates aggressively, 100 basis points in the next 12 months when fiscal policy is where it is and inflation is still problematic?
Is this dollar weakness trend, you think, here to stay?
I think it is. And mostly it's valuation and the underpinnings of the strong dollar are slowly eroding. They're not collapsing, but they're eroding. It's a marginal change. If the U.S. is not going to maintain a multi-percentage point growth differential versus the rest of the world, just going to narrow a bit, given valuations where the dollar is, it's likely to fall. Fiscal policy is being more expansionary outside the United States than maybe inside the United States.
Lisa's been talking about this idea how the bond vigilantes maybe are absent right now from this $3.3 trillion to the deficit the CBO says this bill is going to cost, but maybe they're taking it out when it comes to unwinding in the dollar. Dollar dumpers. Is that what it is now?
I think that's potentially it, that the world is overweight dollar assets, and for good reason. And the dollar has acted as a good hedge for those assets. So if the S&P went down, the dollar went up. That was good. It balanced the risks of owning U.S. assets. As that changes, that there's going to be more dollar hedging going on. So maybe not selling dollar assets, because look where equities are. Why are we worried? But the dollar, maybe we should be hedging our U.S. assets going forward.
Where are you comfortable taking duration risks right now? The whole world's on the menu, by the way. Where are you comfortable taking that risk?
I think it's sort of in the shorter intermediate maturities. Less so today.
So the answer's nowhere.
Well,
the answer is no.
We had this huge rally. We've had, well, not huge, but a reasonably big rally in 2-year notes down to 375 with Fed funds still 4.5. We have to have 100 basis points of rate cuts in the next 9 to 12 months to justify current pricing, which is justifiable if it does happen. Same thing with 10-year treasuries. It's potentially okay if we do deliver 100 basis points of rate cuts.
If we do deliver 100 basis points of rate cuts at a time where the economy is still strong, what happens to the yield curve, though? And this really does ultimately go to a question John asked earlier, which is a really important one. Is there a lesson from what we saw last year from the Fed's 100 basis point rate cut and what that could mean for this one?
Exactly. The last time we had rate cuts last year, the minute they finished rate cuts, 10-year treasuries went up in yield.
Will
and
the same
I think
thing happen?
that's because the same thing happened again. I'm not sure Fed rate cuts help mortgage rates.
What's the president going to say when that happens? That's precisely what happened last year.
I don't know. I mean, what does he say? Does he blame the Fed chair? Does he try to keep Powell in there to try to blame him? Does he say they should start quantitative easing and essentially monetize the debt, which is sort of the worst case scenario for the dollar? How do you jawbone this one, or do you just say rates are too high, cut more? I mean, really, it's really unclear how you message this when it's a very simple message of get rates lower, facing off with a very complicated economic reality of which rate you're talking about.
The latter. It's not enough, cut more.
So that brings in the later risk, which means a new Fed chair later on in 2025. What does all that mean to you?
It means that monetary policy is going to be more uncertain next year. But I'm not sure that a Fed chair of the candidates that are being bandied about are that wildly different than what we've got today. It's a board of governors, it's a committee. If you get Kevin Warsh, one of these other gentlemen or women that are being proposed, will not radically change monetary policy. If we get conditions such that the economy is weakening, we'll get bigger rate cuts.
Well, explore this with me. What if it was the NEC director? What if it was Kevin Hassett, someone in the administration now, works closely with the president, when the president has said very, very clearly what he wants from monetary policy, and then selects someone from within the team, within the White House, within the West Wing?
It's going to be a little unprecedented, I think. In this,
do we sell bonds and sell the dollar that morning?
It would be interesting to see how the board works, how the FOMC works.
I want to know what the market would do beforehand.
I think it would be worried.
The vote would be to sell bonds, sell FX.
So.
Yeah,
I think so.
That's the big risk. That's why we keep saying the market's going to get a vote on this long before the Senate.
And that's the reason why it's sort of interesting that right now the market's saying, OK, keep going. Because right now, if you look at the bond market, you're not seeing any sign of real worry, given the fact that we just had the best rally going back to February. Not the same kind of message, though, coming from the dollar.
And not great music for the ears of Kevin Hassett either, over at the NEC, who some people might think would do a great job over at the Federal Reserve. But the problem is the perception of the market right now. How the market would perceive a move like that, and whether we would just sell bonds and sell the US dollar in the face of that decision.
If you're worried about institutional credibility and you put the person who is in charge of orchestrating the Trump agenda in charge of the Federal Reserve, that independence gets challenged in a very obvious and public way.
Michael, good to see you. It's great to catch up, as always. Michael Kushma there of Morgan Stanley. As we've said repeatedly throughout this morning, it is a shortened trading week, but there's a lot to get through, including payrolls on Thursday and that self-imposed deadline for the tax bill on Friday. Then looking ahead to next week, we've got the trade deadline on July 9th. The week after that, we've got earnings for JP Morgan. So July is going to be a busy month, that's for sure. Busier than Q2. I don't think anything could be busier than Q2.
Don't say that.
And I think we're all looking forward to leaving the second quarter well behind. One more day to go. Coming up a little bit later this morning, look out for the interview with the Treasury Secretary Scott Bessent in the next 40 minutes. Tomorrow, Julian Emmanuel of Evercore, Eric Nelson of Wells Fargo, Bob Michael of JP Morgan, Cameron Dawson of New Edge Wealth. Live from New York City, thank you for choosing Bloomberg TV. We'll see you in the second half.